Buenas tardes. Gracias por acompañarnos a nuestro evento más
Welcome. Thank you for joining us to the most international event of this summit. When we were preparing it for the first time, we considered it was going to be an annual event, but given the very warm welcome of the first edition, we are giving it more continuity. After the service, we realized the outcome was excellent. The scoring to speakers, the asset managers, and the companies were very high, and you also rated us very well in terms of logistics and organization, and you had roaring participation through questions and remarks on the first edition. That's why we were eager to organize the second edition in an environment of uncertainty, albeit many opportunities and challenges. We are asking us lots of questions, how the second wave or even the third wave of COVID-19 is going to affect the portfolios, economies, companies' profits. What will happen if we suddenly find an effective treatment against COVID-19 or a vaccine that can release us from the virus? What can happen with the political instability we are living now? Not only in Spain, but we are seeing coming elections in the US, and also the Brexit is not to be forgotten. The possibilities of a hard Brexit, how will these affect the capital markets, and how can these affect the most conservative part of our portfolios? This fast-changing environment with even negative interest rates. A lot of questions are going to be tried and raised over the next 2 days sessions with the top 10 asset managers in the world that are going to be with us and are going to explain their best investment highlights in the short term. Like on the previous occasion, we are going to have asset managers from Hong Kong, New York, London, and Paris, among others. To all of them, to the partners and different asset managers that have organized this event with us, I'd like to give them a very, very warm thank you for the constant support in the organization of BIOS, to Aberdeen Standard Investments, BlackRock, BNY Mellon Investment Managers, Carmignac Risk Managers, Fidelity International, Janus Henderson, Jupiter Asset Management, M&G Investments, Natixis Investment Managers, Auto BHF, all of them. Thank you very much for your support. Thank you very much for being here today, sharing your thoughts and insights. And I'd like to take the opportunity to thank all the professional organizations that have given us the support in this organization. CFA Society Spain, CSIS, FPA, and the IEAF. Thank you all for joining us over the next 2 day sessions. I hope it is extremely useful and you can enjoy it an awful lot. Thank you very much indeed.
Hola a todos.
Hello everyone, how are you doing? Good afternoon. We truly hope that you're fine, that you are enjoying your day. Thank you very much for joining the second edition of BIOS. As Antonio said, the first one was a roaring success. More than 2,000 people connected in order to receive the best investment insights from the key portfolio managers. The average rating for presentations and the organization of the event was 4.5 over 5. So we said, this is spectacular. So we are going to share with you the best asset managers, 4.5 over 5. We're going to try and outperform it, receive a better rating this time. That's why we kindly encourage you to participate and to follow these with eagerness and enthusiasm with lots of questions. A couple of indicators. The backbone of BIOS will be BIOS group at Finect. So you can connect, you've got the link. Those who are already part of the group, you can check it. This is where we are going to upload the presentations. We will upload links of interest so you can participate. We're also going to have a list of the different investment funds that are part of the portfolio managers firms that are going to participate in this BIOS 2020. you can access through the platform. Obviously, we launched some time ago, and you can hire any of these products. So in BIOS Group in Finect, you've got the list of all those funds of portfolio managers that are going to participate in the second edition of BIOS 2. You've got the information on the screen. How shall we participate? And this is a very important aspect. This is the key aspect behind BIOS 2. Having your questions is most important. You need to have a tab open on your search engine. I will have this web app. You don't need to download anything. And on your computer, for instance, you will have the live streaming session. So on the search engine, you put finect.com/bios. And when you connect, you're going to have the screen with some basic information of the banner of these events, some descriptions. Without doing anything, you're going to have the questions that we're going to submit. We're going to send you a couple of questions in order to understand investors' sentiment, and then you can rate the speakers. So we count on you for your cooperation. Finect.com/bios. Connect. I hope you're all there, and it is important to connect from now. We will just leave it here, finect.com/bios, as you can see on the screen. We're going to ask a first question in order to become a little bit familiar with this web app. The first question is in order to understand a little bit about investor sentiment. It doesn't have to do with any investment assets, but which application have you used the most in 2020? 5 choices you've got. They are Zoom, Netflix, Amazon, YouTube, or Just Eat. So when I say now, I'm going to just launch this survey, and you've got to rate it and vote for it. So finect.com/bios. You've got the survey, and the time starts now. Zoom, Netflix, Amazon, YouTube for videos with sports trainers. Because I was asking a lot of food to be sent home with Just Eat, and I needed a trade-off, and I needed to connect to YouTube with the sports trainers. How interesting. We have already received your votes. Please remember, leave this web app open. Okay, the result goes as follows. Amazing. YouTube, by far. 53.8% have chosen YouTube as the most used application in 2020. Let's now move on to the next question. It's a capital markets related question where we want to understand the investor sentiment. The question goes as follows. Do you think we can reach all-time lows as the ones that we reached in March? No, not anymore. March was the best time opportunity. No, there may be a slight correction. There may be a high risk. Oh, yes, when we go back, it would be a great opportunity. Yes, of course, tough months are ahead. So from most optimistic to less. Go, vote. So those are the options. Yes, these all-time lows, this really depends on the market because to me, the US is almost reaching an all-time low. In Europe, we are far from it. But if we focus in Spain, quite the opposite. We are really reaching all-time lows. So how do you see it? Fantastic. Many of you are voting already. Thank you very much for your participation. The vast majority have chosen the second one. No, there may be a slight correction, but we're not going to see these all-time lows really lift in March. It's very simple. Leave it open. We will continue participating all the session. In this mini app, you're going to have an option where you can ask your questions for those asset managers that are participating. You can ask them as many questions as you wish. but just direct the asset managers and the theme in particular that they are going to cover. And we will just remove the questions as they are solved, so it is clean for the next speech by the next asset manager. You can also rate the question. Let's now dive into the first idea. First of all, remember that the professional associations who are cooperating in this event, the members of those associations, in BIOS group in Finect, you're going to have the link, the information, or on your different associations in order to do the test, in order to receive the certification, so it counts as hours of training. You're also going to have it there. I hope you enjoy tomorrow. Hopefully you will repeat, and let's now dive into the first keynote speaker. Thank you very much indeed. At Fidelity Investments, we have created value over the last 50 years to our clients. Their trust is translated in more than 410 billion AUM worldwide. We generate opportunities thanks to the own analysis that we carry out, independence, innovative company, client-oriented. We work on a daily basis in order to continue generating confidence and value. We're going to start this second edition and traveling real time to Hong Kong. Catherine Yon is a common commentator at Bloomberg, CNBC, or NBC. She really has the sentiment as to the Chinese recovery after the pandemic. And then we go to her studio. Let's now see firsthand if music really sounds so beautifully as the one that she composes with her son. Thank you very much, Catherine, for opening this edition.
Thank you very much for having us. So in December 1978, China's then leader, Deng Xiaoping, announced a new policy which allowed the country to open up and trade with foreign businesses. It was known as the open door policy, a policy which indeed kick-started China's economic and modern transformation. I wanted to show you this picture, which incidentally was taken a couple of years after the introduction of the open door policy. And I wanted to show it to you for two reasons. Now, firstly, it captures a time where people seemed optimistic about the future. This group of relatively trendy young gentlemen positioned in the Bund in Shanghai, and for the first time they were given modern choices, from clothing and hairstyles to the creation of new skills, new jobs, because new industries were opening up. And secondly, this photograph marks the beginning of a very important investment theme, the rise of the Chinese consumer. Now, within this multi-decade investment theme, which continues to play out, certain mini booms can be identified. The first consumption boom was between 1984 to 89, when people's subsistence needs resulted in increased demand for products such as apparel, shoes, bicycles, and TVs. Then we had the period between 1992 to 97, where consumer demand saw growth in home appliances, so refrigerators, washing machines, and air conditioners. We then moved to the third consumption boom, which started in the early 2000s. And this has seen significant changes driven by two key forces: a swelling middle class, which has supported the upgrading of consumer goods, as well as the coming of age of the one-child generation. Behavior-wise, this demographic group is known to spend rather than save. This third boom is all about lifestyle upgrades, so robust demand for cars, apartments, sportswear, cosmetics, designer apparel. And we could even label the past couple of years as the fourth boom, or the beginning of this fourth boom. Technology and innovation are underpinning the consumer upgrade or premiumization theme, as well as technology and innovation helping to create new business models. Now, understanding China's demographic profile as well as understanding the Chinese government's focus on the importance of the domestic consumption story is really crucial when analysing the future growth trajectory of the Chinese consumer. Macro-wise, household consumption is a key contributor to Chinese GDP. And in fact, the country is relying less and less on exports and investment for growth and more on consumer spending. We expect consumption growth to outpace GDP going forward. So take, for example, if GDP annualized returns around 4 to 6%, add another 2 to 3% for broad consumer-related growth, and we're seeing annualized returns between 6 to 9%. But why am I singling out China's middle class as an important structural driver of growth? Well, the middle class has seen improving wealth levels, as you can see from this income chart. And we're also seeing, because of improving wealth and living standards, the middle class having greater discretionary spending. So products and brand promotions that really project success, style, good living, improved health have all gained market share. Then there's a theme of rapid urbanization. And again, as people urbanize, they spend more. And interestingly, across China, it's not just our top tier cities like Shanghai and Beijing, which is seeing this trend, it's all urban cities. And for those of you who aren't familiar with the tiering system, we have top tier cities, like I mentioned, so Shanghai, Shenzhen, top tier. Second tier would be places like Hangzhou, which is a city where Alibaba has its headquarters. Third tier city, fourth tier cities, etc. And again, this trend we're seeing, the middle class, urbanization across all urban cities. I mentioned earlier the psyche of the one-child generation. And whilst the one-child policy no longer exists, it was eradicated in 2016, the spending habits of this generation, including people like me, is very different to the older generation. As I mentioned before, our generation loves to spend. So much so that there's a nickname for this generation called Yuan Guangzhou, which translates into the Moonlight Clan. Basically means you tend to spend your entire salary before you get the next month's pay. Brands are becoming more and more important to this urban, middle-class, one-child generation. And again, if you have this brand, and because people are so image conscious, they're willing to spend on products and services, if you can tap into this as a consumer company, then often you will do very, very well. Now, again, why are brands so important in China? Well, you think back to the 1980s, there really were no brands because of communist society. So take supermarkets, for example. If you need to do groceries, you do them at your local wet market. It wasn't like Spain in the 80s or 90s where you had brands like Aldi, Carrefour, Macando. I think I'm pronouncing that incorrect, so Vasanta, you have to correct my pronunciation during Q&A. But nowadays, there are just a plethora of brands. And not only that, when you do your grocery shopping, it's not just going to the supermarket or hypermarket. In fact, a massive trend that has emerged, probably because of the COVID situation, is online grocery shopping. So for us, the Chinese consumer story is no longer a case of what consumers buy, but how they buy it. Now, on the subject of the health of the Chinese economy, because many clients have been asking us about whether China really is recovering and what we are seeing on the ground here. Well, essentially, yes, we are seeing an extreme period of normalization, which obviously then impacts this theme of consumption. Now, if we look across markets, and don't forget the Chinese equities market is one of the best performing markets year to date, in fact, one of the best performing asset classes. When we look at the markets going forward, there are three key drivers, and that is the flattening of the COVID curve, the pace of economic recovery, and policy response. And this doesn't just apply to China, but across all markets. However, focusing on China, so the flattening of the COVID curve. Well, China has been relatively successful in terms of containment, tracking, monitoring. In fact, during the last big holiday that we just had, the Golden Week period, the festival there, you saw many people even starting to travel without wearing a mask. So in certain cities like Hangzhou, quite common these days for people not to be wearing their masks. The pace of economic recovery, again, China's done well. manufacturing utilization rates had normalized by the beginning of the second quarter. And within the consumer and services sector, we're seeing in general a recovery, and not across all segments. So for example, if we look at travel, as I mentioned, Golden Week, domestic travel up back to 95% normal levels. Overseas travel, obviously stunted because China's borders remain closed. And then finally, that third prong or driver policy response. Well, the regulators in China have been a lot more disciplined, I would argue, and less aggressive versus other central banks in terms of the supportive measures that have been put in place. So yes, we have seen some easing, monetary speaking wise and fiscally, but it hasn't been to the same degree as the rest of the world. Again, what I found really, really interesting in the first half was that fiscally speaking, shopping coupons were distributed across certain cities. So Hangzhou, for example, Shanghai. And this really reflects the importance that the government places on ensuring that the consumer story remains healthy and relatively robust. So as a report card, China has done pretty well across all three metrics. But focusing on the Chinese consumer story, you can see on this chart retail sales, and what's fascinating is the brown line, which shows online sales. So what we did see, even in the first half of the year, so year to date, ending the first half, and taking into consideration the complete shutdown we did see nationwide during February, online sales still grew by 10% year on year. Now that China is fully recovered, you're seeing a lot of the e-commerce companies upgrade or up their revisions to normal levels. Parcel delivery companies such as SF Express, CTO have also increased their full-year parcel volume target from original pre-COVID levels of between 20 to 30% year-on-year growth to 30 to 50% year-on-year growth. But the shift online isn't just due to COVID, it's a long-term structural trend. And again, many consumer goods companies are saying this is where their big focus is on, their e-commerce business. Many of them adjusting channel and product strategies to react to this new structural change. Also, when it comes to online, another thing to remember is that the services economy is now outpacing the growth of physical goods. So companies, not just in e-commerce, but entertainment, education, healthcare, fintech, they're all shifting their services online. Another structural trend we are seeing this year in particular is the middle class really caring more about quality. So as this pie chart shows, the biggest concern or focus the middle class consumers have is on quality. Again, very different to the rural consumer base. For rural consumers, it's all about the pricing point and good deals. And again, this is important to remember in China. It's a big country. Demographically, not everyone behaves in the same way. Along with quality comes the premiumization theme. So whether it's from cars, noodles, etc. And when we talk about quality, it's not just about the ingredients or materials that a product or services uses. It's also about customer service, branding, marketing. A great example of a company that really dominates a particular subcategory within consumer staples is the world's largest soy sauce manufacturer. Now, don't forget, in terms of ingredients, soy sauce can't be replaced by another sauce in Chinese cooking. So it's a staple ingredient. And this company has different soy sauce prices. So from the basic brand all the way to a premium brand, also has other sauces. And its dominance can be viewed in terms of when you go to a supermarket, the shelf space that this brand has. Another big trend we're seeing is that as quality becomes more important, as national pride becomes more and more important, so too are local brands in terms of their dominance from a market share point of view. Chinese consumers becoming more affluent, more educated, they're feeling more confident about their culture. Again, the product brand also and quality really important. It's happening in food and beverages, even in the car space. So yes, German luxury brands still remain strong, but upcoming local electric vehicle brands such as Leo and Xpeng have successfully gained consumer mindshare. What's more, consumers perceive these local brands as high-tech, high quality, but better value for money. So Chinese companies are making this big shift from made in China to designed and created in China. Even if we look at the fashion market, there's a brand called JMBY. I guess I'd compare this a little bit to Massimo Dutti. And it's a homegrown company. They use innovation. They understand their customer to gain market share. So loyal shoppers who spend even when the climate is weak. Again, when we look at the demographic profile, the Chinese brands, there's a company called Bilibili. And in the first question, the most popular response was YouTube. Well, Bilibili is the YouTube of China, but for Generation Z. So our trader in Shanghai keeps teasing me that I wouldn't have any idea about Bilibili because I'm the wrong age category. They have a lot of anime. They really appeal to this generation. In fact, you have to take a quiz of 100 questions before you become a member. The average age is 21, and 90% of the users are 25. In fact, one of the other fund managers I work with took the quiz and failed. And the quiz question usually is about etiquette on the site itself. And then you have brands such as Meituan, again, a local brand. They own 60% of the market share in online food. They also do online hotels. They did do bikes. They do coupon selling. And now they've morphed into delivering their food using autonomous driving, especially in the age of COVID. So really, when it's about the consumer story, yes, you can buy traditional products, but I love this picture again because look at how you pay for a traditional product. It's using very high-tech payment systems, a QR code. And this is just a street stall in the middle of one of the cities I was visiting, and that's how he's selling his products to his consumer base. So whether it's traditional products or indeed whether it's these local fashion brands who are showing their ranges in New York and Paris at all these big fashion weeks, this is what the consumer story is about. And I wouldn't be surprised if soon, after we start seeing the domestic brands really tap into the domestic market, that these brands start hitting your high street. Thanks very much.
Gracias, Catherine, por tu presentación.
Thank you, Catherine, for your presentation. Thank you. Thank you so much, especially for being with us at this time of day, because you've already had dinner in Hong Kong at this time. You're close to getting to bed. So thank you. Thank you so much for being with us here today. And let me just remind our audience to say that they can ask their questions. They have an app, finect.com/BIOS, and that's where you have the app where you can ask your questions. And we're going to start with one of the questions. I'm going to start with the last one that just got to me. It says, Catherine, although Chinese economy is making so much progress, don't you think that there is still some sort of commercial frontier that is being set by Asian countries to European and American consumers?
These products leaving China?
Yeah, I think so.
Tapping into... Yeah, I guess from a Chinese company's perspective, and as I mentioned earlier, the local market is so vast that the attention from a business strategy point of view is dominating that space. So even if we look at Alibaba, Tencent, even ByteDance, who owns TikTok, it's all about the Chinese penetration. But yes, again, these companies are now doing M&A activities and building infrastructure around Southeast Asia and the rest of the region. They're selling their products into, Europe, into the US, into Latin America. And the issue that we're probably going to see is, for example, take Apple versus Huawei or Amazon versus Alibaba. At some point, you're going to see countries or the companies within these countries competing for global market share. But again, at this point in time, and even President Xi Jinping has been recently talking about this, there's this focus on what we call dual circulation. So ensuring the health of the domestic consumer, the health of the domestic economy, but at the same time being really cautious about ensuring there's no disruption to China's supply chains. But yes, I do think that a big trend long term will be these Chinese brands, because they're better quality now, really climbing up the value chain and selling their products to overseas markets.
¿Cómo estáis viendo, Catherine?
How are you seeing, Catherine, the companies that you invest in, the the way in which they see this recovery, not just the recovery you talked about, consumption and economy, but also how are they seeing what is happening the world over? Because it's true that although they mainly focus on the local market, they also have part of the world market share. So how are you seeing both consumers and entrepreneurs see that?
You know, when I think about the entrepreneur spirit, in fact, I was just at a company management dinner with entrepreneurs, in fact, so a private equity management team. And what's fascinating is that there's a lot of collaboration within the entrepreneur set, not just within China, but across the region. And I think that's really, really healthy. Now, the area of risk for China really relates to the export segment. So as I mentioned, whilst the Chinese government's really focusing on growth being driven by the consumer and private services sector, we can't underestimate that exports and fixed asset investment spending is still part of the Chinese economic makeup. And what's happened is, yes, just because we've seen a recovery, be it in manufacturing, be it in domestic demand in China, doesn't mean, as you rightly pointed out, the rest of the world will see the same kind of recovery trend. And so, again, that's where the risk is, that the global demand story isn't going to be as robust as what we have seen in China, which could put some stress on the exporters.
Una pregunta también.
I also have a very interesting question, which is, what can you say about the risks with regards to bad accounting in Chinese companies? Has that improved?
It's really interesting because I mentioned how consumers are heavily focusing on quality. And what we are also seeing is, and this is a global phenomenon, but also happening in China, is the focus on improving sustainable investing, whether it's a focus on environmental, social, as well as corporate governance. And I would actually argue that across the Asia-Pacific region, the country over the past 2 years that has made the most progress has been China. And one of the reasons is this. In 2018, in September, actually, we saw some revisions to the corporate governance code, which is basically law in China. So whereby, as an example, every listed company has to have a dividend policy. So now the regulators are really on top of transparency when it comes to books and accounts. You are seeing this progress. I'm not saying every company is doing exceptionally well, but when we speak to management teams across all segments, whether it's private, whether it's public, whether it's private equity, they're just focused on really being a lot more transparent. And again, I think it's the improvement over such a short period that is really, really promising.
Precisamente, hay una pregunta.
Precisely. There is a question that says, aren't Chinese companies looking for ideas in European or continental companies so that they can find ideas and then sell them at a cheaper price?
I think that period's actually passed. So China no longer wants to be the copycat. They want to be the next generation developers. And this, again, has really been supported by the Chinese government over the years, whether it's through the Made in 2025 strategy or the dual circulation strategy. By the way, the Chinese government really enjoys having policy names like I've been referring to over the past sort of 20 minutes or so. And so take, for example, I'm just going to use another company, a fashion designer company, or it's a sports apparel company, Li Ning. Li Ning's a really well-known brand because the chairman is actually a very famous gymnast called Li Ning. In fact, some of you might remember him. He was a gentleman that was on the ceiling lighting the cauldron at the Beijing 2008 Olympics. Now, Li Ning actually created, it's a real special situation or turnaround situation or story, because a few years ago, they created their own brand called China Li Ning. And what China Li Ning did or does is that they've modernized what Li Ning wore when he won all his medals in the LA Games, etc. And it's a streetwear line with really high quality, higher margins than the Li Ning brand, just the outright Li Ning. But it's interesting because they're not copying Lululemon or Nike or Adidas. They're identifying the Chinese culture and sort of making it modern and high quality. And this turnaround story in fashion, it's quite hard to achieve, but Li Ning has done just that. And again, so it's a Chinese identity really now coming at a high quality, higher margins, and definitely not copying other brands or Western brands.
Catherine, tenemos un problema, es que tenemos
Catherine, we have a problem because we have lots of questions, but we are running out of time. So I'm going to ask you 2 more questions, and I will ask you to briefly respond to both of them so that we can give the floor to the next guest. The first one is, what has China done so well so that they are the fer de lance, and what is it that we in the rest of the world have not done? That's with regards to the pandemic.
What they've done, I think it's the tracking and monitoring and acting very, very quickly. So again, even in March, when the factory workers started working again, there was really strict monitoring, because if, for example, they had a utilization target of 80-90% by the end of March, you couldn't see like the workers getting infected. I think it's also probably the mask wearing initially, and then just the washing of hands. And, you know, I guess when a city was contained, or the measures were put in place, they stuck to it. And I think that sort of helped China. But again, the caveat is still that they haven't opened their borders. And so that's probably why you're also seeing a lot of success across the country.
Y la final.
And the last question, we have talked about investment opportunities, but with regards to assessment, what would you say about the market, the Chinese market, and companies that are dedicating their efforts to investing and to launching their products to the market? How do you see the investment opportunities?
I think there's a long runway of growth, especially for these domestic brands, these innovative brands, as I've been talking about, high quality, really getting to know your customer and understanding them. The risk, though, and it's all about risk return, by the way, is it's the multiples in these areas, big tech, biotech, consumer-driven names, is they're very, very stretched. So a bit of a situation that we're also seeing in the US market. And the other issue is that the competitive intensity is huge. Yes, there's a lot of demand for products. You know, as I mentioned, all these brands coming to market, but really understanding the strategies of the companies, making sure that they can retain or increase their market share is really, really key. Great for consumers, but for investors, you do have to be cognizant of that competitive intensity threat.
Pues muchísimas gracias por...
Okay, thank you so much for your time, Catherine. It was a real pleasure to talk to you. Thank you so much for being with us at this time, because it's already 5 in Spain and you're almost going to bed at Hong Kong. So thank you so much for your time.
Thank you.
Muy bien, pues ahora, como sabéis...
Okay, so as you know, we are now going to grade this, finect.com/BIOS. Please keep your app open, because we're going to ask 2 questions for every manager. And we have a hashtag, which is BIOS 2020. So if you're tweeting, that's our hashtag. And the first question is, do you think that it is a good opportunity, a good investment opportunity, that Catherine Young's idea is a good investment opportunity? So 5 stars if you think it's good, and 1 if you think it's not at all a good idea. And the time to vote starts now. There we go. So this is the investment opportunity for Chinese consumers. See, they are recovering that trust, but it's a pity because we're not that close here in Spain. Okay, thank you very much. Thank you for your votes. And now the second one. So now the investment opportunity. What did you think about her presentation, and what did you think about the way in which she introduced this idea to all of us? And the time to vote starts now. Okay, so 5 is the best grade you can give her, and 1 would be the worst. So here are the votings. This really helps us to give a better quality to this event. Okay, thank you. Thank you so much for your vote, for your voting. And now let's start with the second guest of the day. Okay, so we're now going all the way to London, where Ben Ritchie is waiting for us. This asset manager has been in Aberdeen for 18 years, but he's actually been investing his whole life, ever since his grandfather gave him part of his portfolio. When he closes his screens, he relaxes by cooking for his family. So let's now look at his specialty, what the chef has cooked for us now. So the floor is yours, Ben.
Go ahead.
Very much. Very kind introduction. As saying, I don't think what I'm going to say is as interesting as Catherine had to say on China. Europe has not been in favor for many years. But we do believe that the next decade looks a lot more interesting, a lot more exciting for investors than the last 10 years. And I certainly am very confident that the companies which we can find in this market are going to do a lot better on a relative basis over the next 10 years than they did against the United States over the last 10. And I'm going to talk a little bit about the market structure, about the opportunities, and why we think a very focused and concentrated portfolio of well-selected companies in the European context can be as exciting as businesses you can find anywhere in the world. If we start by setting a bit of context, we know that we've been in an environment that's very tough. The economy has contracted significantly. It's a record in terms of the economic decline, not just in Europe, but globally. And this is going to have a big impact on longer term levels of growth and inflation for the wider world. That's the backdrop which we're operating in. And I suspect for all the discussion about inflation, what it means from increased government spending, that we're going to be operating in an environment of low growth, low interest rates, and low inflation for many years to come. And coronavirus has done nothing to improve that situation. Now, that doesn't sound like a great starting point, but believe me, even in that environment, we can find businesses. They've done well over the last decade. We think they'll do well over the next 10 years within the European context. So if we look at what's happened in recent times, if you look at the black line on this chart, you can see that the cyclical part of the market fell quite sharply during the first part of March and April in Europe. It's rebounded almost all the way back to where it was at the start of February. So we've already seen a really big recovery in equity markets, and the more defensive part of the market, more resilient in the early stages of the downturn, a slightly slower slope. But broadly speaking, with the exception of oil and gas, banks and airlines / travel and leisure, most parts of the market are at or above where they were in March. So we've already seen a very substantial recovery for equity markets. And if we look at the economy, again, we've actually seen a very sharp rebound. So if we look at the various leading indicators, you can already see that most of these are already on the upper side of the shoulders of recovery. And I think perhaps, if anything, we might be starting to see a little bit of a slowdown in terms of the recovery, which we're seeing overall, having seen that very sharp rebound. So where we are today in markets is an economy that suffered a very sharp decline. We've seen equities move well ahead to anticipate the recovery. We've seen the economic recovery come through, and we're now in a somewhat more benign environment. When we look longer term over the last decade, we can see that the European earnings performance was generally quite disappointing. So if you look from 2010 through to 2019, European earnings growth was less than 2% per annum. And if you look at what we're going to see in this year, where earnings are down perhaps 30%, then that's going to do nothing to improve that picture. So overall, it's been a pretty tough environment for corporate earnings over the last decade. But how do we see things moving forward from here? Well, I think we've already seen a substantial monetary policy support for economies. You can see that on the left-hand side, where we've seen interest rates cut still further, bigger levels of support coming through in terms of monetary policy. And I think it's fair to say that Europe, for once, has acted quickly and decisively in terms of supporting its economy. And many of the errors that were made during the 2010-2012 period of the Eurozone crisis have been corrected here. And both governments and the ECB have responded relatively quickly to providing both monetary and fiscal support to the economies. And that, I think, is really important. And you can see that on the right-hand side, where the national levels of support amongst European countries are some of the highest in the world. If we look to ESG, again, we see COVID potentially as a major trigger for ESG investing. Not just because of the environment, which is an ongoing factor, but because I think it's raising awareness of social factors in a way that we hadn't seen before. So if environment was right on the table before, if governance had been on the table for many years before that, then we think this is bringing social focus as well. And so the whole ESG agenda is moving much more up the page for investors, both within the market and outside. And that's important for Europe because Europe is a leader in ESG. Its companies score much more highly than those in other markets. And critically, this data going up to the start of the COVID crisis, companies and strategies that integrate ESG have been outperforming. And that's a trend which we expect to see going forward, not only as companies take advantage of opportunities thrown up by ESG, but as we start to see capital flows flowing after that money. One of the reasons why, though, we're optimistic about Europe over the next 10 years is that its companies are well geared in to attractive long-term trends. Investors have spent much of the most decade agonizing over ECB policy, the travails of European banks and so forth. But actually, European companies with the intellectual property that they have, the heritage that they have, the positioning that they have, are actually in excellent shape, whether that's about global brands, the ability to take advantage of changing demographics globally. And while we don't have a Silicon Valley in Europe, we have plenty of excellent tech companies, particularly able to take advantage of the shift to digitalization within industry. And that's going to be an important trend going forward that we think Europe is well positioned for relative to the United States in a way that it wasn't in terms of the shift towards consumer platforms over the last decade. And that, when we put that all together, has meant that our portfolio, in contrast to that sub 2% earnings growth that you've seen for the wider market, has been able to grow its earnings at about 10% per annum over the last 16 or 17 years. So this is looking at the companies which we own today, looking back over that time period. So in a relatively challenging economic environment, companies that you can find in the market, if you're selective, have still been able to grow earnings at double-digit rates and cash flow at high single-digit rates. And that's going to drive attractive total returns to investors. A great example of a business operating in one of the economies that's been one of the real laggards in Europe would be Amplifon. Italian listed, makes about 30% of its money in Italy, but despite that, a business that has tremendous opportunities for growth. First of all, demographics is meaning that more people are using hearing aids. There's plenty of opportunity to consolidate what is a very fragmented industry, and there's also the opportunity to expand on a geographic basis to places like China and Latin America. So this is a business which has been able to grow its earnings at very high rates over many years, and which we expect will be able to continue going forward, despite the fact that at its heart, it's just a retailer of hearing aids from Italy. The other thing that we think is attractive about European equities from here is the valuation. So when we look at valuations against credit, we believe that they are truly compelling. If you look to the left-hand side, you can see that the yield spread, and this is after the substantial dividend cuts which we've seen in the first part of this year, is still offering a 350 basis point spread over long-term government bonds. And you've got to remember that that's a cash flow that's going to be growing over the long term. And you can see that the earnings yield gap is also extremely wide. And when we look at our own portfolio of high-quality businesses, we've still got a free cash flow yield of around 4%, which we think will be growing at high single-digit rates. That's still an implied return in the teens, which we think, again, looks compelling compared to government bonds where you're actually having to pay the government to lend them money. When we look at our portfolio, it's managed by a small team, myself, Sanjeet, Ian, Jonathan, with ESG input from Rosie. We like small teams. We think they bring accountability, but they also allow us to be able to make decisions in a clear and decisive way. And we've been running the strategy for just over 5 years. Very focused on finding the best businesses in Europe, idea generation from across the market's cap spectrum, really focusing in on the best businesses which we can find. And that's driving a high active share portfolio, high tracking error, low turnover because we're long-term investors, good upside capture, good resilience on the downside. And we think that makes a really attractive risk-adjusted outcome for our investors, and the fund performance has been strong over the longer term. And we look across this market in Europe, having the research capability to be able to tackle the market is really important. So we think there are about 800 businesses in Europe bigger than 3 billion euros. On top of that, you've then got all of the smaller companies to look at as well. So we're in a great position with over 30 analysts covering Europe to be able to do that effectively, and then also leverage our excellent smaller companies team. And that sort of 800 or so is then boiled down to a couple of hundred buy ideas. And that really forms the heart of driving a portfolio of around 30 companies at the end of the day for us. And it's really focusing in on those very, very good, high-quality businesses across Europe. And that's the absolute bedrock of everything which we're doing. Of that 800 companies, around 10 to 15% meet our quality criteria. So we're talking about 100. And then we're looking to build that portfolio of about 30 names. So where we find the intersection of attractive buy ideas and high quality, that's really the sweet spot for us in terms of finding companies for our portfolio. As you can see, the long-term performance of our strategy has been strong through a range of different environments, whether times have been good or bad. And again, we think that this is a strategy that's very much an all-weather core holding for investors, which can deliver good returns in good markets and be resilient in tough markets as well. ESG remains a very important part of what we're doing. And for ASI, that's not a new thing. We've been incorporating into our investing over much of the last 30 years. And having an integrated approach, even though this is not an ESG or SRI strategy, means that it puts us in a very good position to be able to avoid the risks that are caused by poor environmental management, social risks, and also poor governance. That's a very important part. And as I sort of showed earlier, ESG is one of the key factors we screen for in terms of quality. And that allows us to have a portfolio that has very low levels of carbon intensity and very, very good levels of governance and social scores within it. So when we look at our strategy over the long term, why are we confident? The strategy has done well, but when we look back over the last 30 or 40 years, a focus on lower beta, a focus on high returns has been the right place to be over the longer term. Those are things that are embedded into what we're looking for. Focusing on strong balance sheets, again, has generally been a trend which works over the long term. Doesn't work all the time, but it works over the long term and protects value. And then when we look at this environment of low growth, low inflation, low interest rates, we're not saying that Europe's Japan, but we are saying we're operating in a low growth environment. A strategy that focuses in on resilience, on cash generation, on the available growth that you can find in the market, we think makes an awful lot of sense. So we think we're well positioned to benefit from some of these big trends that are coming through over the 2020s. We think the valuation of our portfolio is pretty compelling relative to bonds and cash. We think we've got the capabilities to be able to exploit the opportunities, and the performance of the strategy has been relatively strong, with ESG really at the heart of what we're doing. And despite its challenges, we think Europe, for the stock picker, remains a really interesting market over the next decade. So with that, I'll stop and pause for questions. Thank you very much.
Muchas gracias, Ben. Tenemos ya.
Thank you very much indeed, Ben. We've got several questions and soon we will receive more. The most rated question, obviously, we are seeing the cases, the COVID-19 cases during the second wave, reaching all-time highs in most European countries over the weekend. And the question goes as follows, Ben. How do you think Europe will recover during this next wave? And if we have additional waves, how do you think this is going to affect the recovery and the European asset classes? Thank you very much indeed.
Yeah, no, it's a great question. So I don't think we've ever believed that we're going to see a straight line recovery, that we thought that there would be bumps and troughs. When you looked at the original modeling of this, without a vaccine, what you see is peaks, less high peaks, but an oscillation of peaks and action taken between the peaks to restrict the virus. I think it's critical that Europe maintains its fiscal support and its monetary policy support, and it's prepared to be aggressive in that way. I think if we tighten the taps too early, we're going to risk causing some of the problems we've had in the past. And I think policymakers are aware of that, and they'll be doing their best. From a portfolio perspective, I also think, though, it's very important to have a portfolio which is all weather, because we never know what's going to happen. No one had heard of COVID-19 in January. You never know what kind of environment you're going to be in. And whatever happens, we want to be in a position that our companies are resilient and able to manage through what is undoubtedly going to be a trickier time. I hope we're through the worst in terms of the economy, but we may not be. And if we're not, then we're going to be in a more volatile time. But I do think when I look at the holdings in the portfolio, we feel relatively confident about the prospects, even if we are going to be in a more choppy economic environment.
Hay aquí una pregunta.
There's another question related to the European recovery plan. it was received very positively by many PMs. At last, Europe is jumping on the bandwagon. You said it positively, but questions are, is this going to be implemented as it was initially agreed upon? And how do you think this is going to affect your portfolio holdings if the plan comes to fruition or not?
And so, recently we've been talking about what are the big narratives we want to talk about from a European perspective looking forward over the next 10 years. And there are two things that I've explicitly said I don't want to talk about. The first one is politics, and the second one is PMIs. Because in my experience, those things tend to be disappointing. So whenever we back politicians, they tend to let us down. Whenever we look at the economic data and say it's recovering, it tends to turn the other way. And that's been my experience over 20 years of covering European equities. So let's focus on the companies. They tend to be the best thing that we've got available to us and what they can deliver. Now, when we do that, we still get pretty excited about the potential over the next decade. I think what we've seen with the recovery fund, it's definitely a positive. It shows a much greater degree of cohesion than we've seen in the past, and hopefully we're going to be able to reallocate some money from the wealthier areas of Europe to some of the poor areas that need that support. But when you actually look at the details, it's some money, it's not that much money, and it's not all coming at once, and it's going to take a while to be delivered. So I think the symbolism of it is probably more important than the quantum of it. But nonetheless, I think it shows that Europe is prepared to act in a cohesive way without necessarily having a massive crisis to force it to do so, which is what we've always seen in the past. So I think in terms of the speed of action and the impact, I think that's the bit that we should be pleased about. But I don't think we want to overstate the actual economic benefit of the recovery plan because it is relatively modest in the context of European GDP and spread out over a number of years.
Ben, preguntan por...
What about cyclical assets, these values, these equities? Do you think it is the time to start asset rotation of cyclical assets?
Well, I think, tried to show there that generally speaking, most cyclicals have performed pretty strongly. So we've already, with the exception of oil, banks and airlines and companies, hotel companies, your cyclicals are back above, if not even way above where they were in February. So I think you've seen, a big level of recovery already baked back into markets. And I think those assets are probably more at risk from a second wave and earnings growth starting to tail off than anything else. So I think overall, we're not chasing cyclicals within the portfolio. I think if anything, we'd probably be minded to be being a little bit more judicious around that. And that would be our sort of, kind of overall positioning. I mean, we haven't done much during the year. I think, we felt relatively well positioned going into tough conditions. We've bought a few things over the last 3 or 4 months. But we didn't buy a huge amount of stock back in March and April, which we should have done. That would have been a great opportunity. But I think having not done that, I think where we look today, I'm not sure I would want to be piling into the more cyclical parts of the market at this stage, where I think the outlook is looking a little bit more balanced. And then you've got valuations which have already gone up to reasonably full levels.
Ben, aunque me han pasado...
We've got people connected from different countries in Europe, but most of them are Spaniards. How European equity PM sees Spain? Do you see interesting opportunities in the Spanish market? What is your opinion about this?
Yeah, well, I think, Spain is a market that's dominated by some quite large sectors. And typically, we haven't really had a lot of joy necessarily within some of those bigger sectors. But when we look at individual businesses, we still find some really leading companies. So something like Iberdrola within the utility space. We still think Inditex is a very good business. We've owned in certain funds things like Bank Inter over the years, which although banking is a tough market, they are very good in that space. Within the portfolio, we have Amadeus as well, which has had a tough time. But again, we think it's a very strong business and it will get through this period and will perform well. So, what I generally find in Europe is that in any market, you can find some really great companies, and quite often countries tend to get overlooked or can get overlooked because of the politics or the macroeconomic dynamics, when actually there are a lot of businesses operating within that market where, that doesn't really matter that much. So if you think about something having like something like Grifols, which is a business which our smaller companies colleagues own. The dynamics and opportunities for that company are not really shaped by ECB policy. They're really shaped by the potential that the company has within itself. So those are the types of things which get us interested. And in my Spain has as many good opportunities really as any other market.
Ben, how do you see the tourist sector? Thank you.
Well, I think it's going to be tough for sure. So, again, within that, where you see these businesses that have been really heavily affected by COVID-19, you've got to go, I think, with the ones that have got really strong balance sheets and can maybe survive not having a lot of business for the next couple of years. I think that has to be your base case. So, we looked at some things within that area. There's a German company called CTS Eventum, which is a ticketing business. So it's not exactly a tourist business, but it's effectively a leisure business, and it depends entirely on live events. Clearly they're not got a lot going on right now, but it's a business that has a very strong balance sheet. So that's the kind of company where if you can afford to take a couple of year view, you may think that that could come through. I mean, Amadeus would be an example where, we're still holding that business. We've added to it selectively over the last 6 or 7 months. We think over this crisis, they have the potential to come out even stronger than they were before. But clearly, it's tough if you make a business where you take a clip on the number of people going through an airport or on the number of plane tickets and no one's flying. That's tough, right? But I think they're going to get through it. And, hopefully they'll come out the other side as a stronger business, and their competitors will be weaker because they're spending, billions of dollars a year on R&D. So, there is potentially a plus side over the longer term as well, although it's difficult to see that at the moment in some ways.
La verdad es que como pasaba antes con...
I do have so many questions, just like what we had with Catherine, but I'm going to choose a couple. I'd like to thank all of those participating with your questions and comments. I'm going to just carefully select a few of them. Ben, this is a very interesting one. You talked about quality, right? Quality is your safety margin. When do you think you can be overpaying for quality?
Question. People have been asking me that for about 10 years. I think it's a really important thing. We always want to be making sure we're disciplined on valuation. And I think it really comes back to what sort of return do we think we're going to get from an investment? And that's my valuation framework. So we're always thinking about what are we paying? What is the growth we're going to get from this asset? And what's our confidence around that? And as long as we think that those two things, the free cash flow yield, the earnings yield, and the sustainable growth are implied delivery is 10% plus annual return, then we think that's our kind of hurdle rate. And if we can continue to deliver that, then that I think is will ultimately end up being a good overall return. And that's the bedrock of what we're looking for. Yes, the quality companies are more expensive than the lower quality companies, and you've seen all those charts that show that spread. But if you look at, say, something like, I don't know, Nestle, it's not a particularly exciting company, but if you compare that to a European 10-year government bond, I would say Nestle is phenomenally compelling. You've got a free cash flow yield of 4 or 5%. You've got earnings growth of probably close to high single digits, or you could put your money in with the German government for minus 60 basis points. To my mind, it's not Nestle that's overvalued in that regard.
Bueno, y vamos a...
Since we've got to choose one, we are going to wrap up with this one. What's your view on small caps in Europe? Do you think they're going to be lagging behind the large caps? Thank you.
Yeah, I still think there's some great opportunities in the small cap market. And when I'm talking to Andrew Paisley or Anjali Shah, who manage our European small company strategy, I think they probably feel there are more opportunities now than there were a little bit earlier. I think the picture is a little bit clearer from an economic perspective. And certainly, I think we've got more ideas coming through from them today than we had 6 months ago. So I think it's interesting. I don't tend to see it as in my own mind as small caps will outperform, big caps will outperform. I tend to think about it at the company level and what are the interesting opportunities which we've got coming through. But there certainly are a few out there. I mean, one in Spain that Anjali has been talking about is CIE Automotive. It's a business which operates in a cyclical industry, but it's got a great business model. The company's done a great job over the long run, and it's pretty cheap. And if you believe that there's going to be a recovery in automotive production, then that's probably quite an interesting quite an interesting thing to look at. So, we do see there's more ideas coming through now. The economic situation looks a little bit more stable. So, yeah, I think it's an area you may see us, dipping our toes a little bit more into the smaller companies part of the market.
Muy bien, Ben. Pues ha sido un...
Thank you very much, Ben. It was a sheer pleasure to have you with us in this afternoon. Thank you very much for your time.
Thank you very much. It was great. Thank you.
We love your participation. Just share it and click on likes, please, because this is also very important. As important as the assessment to the different PMs that are participating. These are the questions that we are always asking you to talk about the investment inside and the PM that has mentioned it. You've said it 3 million times, but the Finect.com/BIOS. The first question is, how do you see this investment idea in European equities? Thank you very much. Time starts now.
Vamos a ver vuestras valoraciones. Vamos a ver qué os ha parecido. Esto siempre es interesante, ¿eh? Para nosotros es muy interesante. Muy bien, muchas gracias. Y ahora vamos.
Thank you very much indeed. What do you think about the explanation by Ben Ritchie? Time starts now.
Muy bien, muchas gracias a todos por vuestras votaciones.
Thank you for voting. Please remember that the slides are going to be uploaded on the group, okay, as they finish, okay? You have them there. And please remember that the asset managers funds information or sheet is available as well on this banner I showed you. And even for hiring those. Follow the next one closely. We have a keynote speaker now. Let's go with the third keynote speaker today. Janus Henderson offers you investment solutions with 350 professional investors all around the world. We believe our active asset management can provide you with a unique experience. Do not let uncertainty of the capital markets to step in the way. Thank you very much indeed. Janus Henderson. Forget about your doubts, but do not forget about your financial targets.
Seguimos cerca del Támesis.
We are still close to the Thames, and Tom Rose is the Portfolio Credit Portfolio Manager since 2006. If you know something about the markets, is that they can become a long, enduring battle that he loves practicing. He is a prominent expert in this field, but I'm certain that rugby playing has helped him tremendously with a triathlon or a girls group. Thank you very much indeed for joining us today, Tom.
Thank you very much indeed. Right, okay, so let's get started. So we're going to talk about high yield, and is this the new 2009? And obviously, if we think back to 2009, that early part of the credit cycle, that was such a great opportunity for credit investors and for returns within the high yield market. Now, why was it such a great opportunity? Well, that was because it was early cycle, and that's what we're really looking at now. Is what opportunities do we have within the early part of the credit cycle? So, excuse me 1 second. So we move on to the first slide. So whenever we think about the market, the first thing I'll do, I'll give a market outlook. We're going to talk about the opportunities, and then we're also going to then talk a little bit about positioning and also about some of the ESG trends as well. But if we think about the market, the most important thing we have to consider is really thinking about the fundamentals. And the one thing, whilst this does feel early cycle to us, is that it is a little bit, it's not like your sort of usual cycle that you have. And one of the reasons for that is that we have so much uncertainty around the economy. Now, these are all things you're going to be very aware of, whether it be the daily case count from the virus, whether it be geopolitical risk. Obviously, this is all sort of coinciding with the US election cycle. We've also got the Brexit situation. As you can see here from the bottom left chart, gold's at all-time highs, and VIX remains pretty elevated as well. So there's quite a bit of uncertainty there to this recovery, more so than we would probably have during a normal economic recovery at the start of an early cycle. But on the other side to that, we've clearly got this enormous central bank response. Look, everyone's aware of that graph top left and simply how significant it is. But I just want to draw your attention to how big it is compared to what we had in 2008. Now, we currently have, obviously, global investment grade. We have government bonds as a significant policy tool. We also have within the US high yield, that's also becoming a policy tool as well, with fallen angels and ETFs potentially being bought by the Federal Reserve. Now, those direct purchases are positive. They do sort of dampen volatility, which is very important for credit. But the single most important factor in our view of this central bank support is the dampening of yields. As we heard from our last presenter, minus 60 basis points from German bunds. That is really causing this grab for yield. And the one difference now that we had even versus a couple of years ago is that even US Treasuries barely yield anything anymore either. High yield remains one of the few asset classes where investors can get some yield. Now, alongside that, we have this other sort of positive dynamic that grab for yield, as you can see from the top right chart, is manifesting itself in some inflows into the US high yield market. In fact, European high yield hasn't seen that as many inflows as we might have expected this year. But the one point I want to make about high yield is that it's not a particularly hot asset class. We haven't seen a huge amount of investment in the high yield market over the past how many years. 2017 saw outflows, 2018 saw outflows, 2019 probably offset about half of that. Again, not many investors are invested in high yield, and I still think we're now starting to see evidence of investors coming through to that. And also, you're seeing investment grade funds buy high yield. You're also, in fact, starting to see aggregate funds buying high yield as well, as they also recognize that we're in the sort of early part of the cycle. So we believe this trend of grab for yield is going to be going for a long period of time. Now, the other side of demand we have is supply. And bottom left, you can see there that actually we have had quite a lot of gross supply this year, and especially if you take August record figures in the US. But in fact, most of that supply has been refinancing. So the net supply figures aren't that great. And as we start to look into 2021, those supply figures are probably, we expect them going to be dropping off as well. So there's not a huge amount of supply. And again, because it's sort of early cycle, we're not really expecting a huge amount of sort of LBOs and other sort of more sort of shareholder friendly activity from those companies that necessarily don't want to do that. Some of them might do, but again, they're the companies that can probably afford to do that. And then finally, valuations, which is the last pillar that we really look at after the fundamentals and the market dynamics. Valuations are okay. Look, they're clearly not as compelling as they were earlier on this year. But in fact, now they're still representing some value as we look forward. And I also question as well, why potentially couldn't we see even tighter tights through this part of the cycle, given that level of central bank support and that grab for yield that arguably is going to be even greater this time round than it has been in previous cycles. So that does mean potentially there are some upsides there. Now, overall, when we then look at the market, that sort of leaves us to be quite positive. So we have a -3 to +3 scale on how bearish to bullish we are. We're currently at a +1. So we do think spreads are going to tighten. We do think excess returns are going to be positive going forward. It's just the case that because of the COVID risk and the potential for these ongoing waves to disrupt the economy, and potentially maybe a little bit of that political risk could just sort of unsettle the market. As we start to work our way through those, and for example, the US election, we start to believe, especially if it's a blue wave, that will probably reduce the risk of there not being a fiscal package, or potentially it might also reduce the risk of trade wars going forward. Those are the types of things when we work through that can actually lead to us getting more positive, we believe, on the market going forward. Now, let's look at the other parts of high yield, because a lot of people talk about defaults. We can see there from the top right chart, defaults expectations jumped up quite high. They've come down very quickly as well. In fact, we expect possibly around 3% this year within Europe, similar sort of within EM high yield, and even US high yield, where you have that larger energy exposure, is still probably going to be sort of mid to high sort of single digits. So nothing like the sort of expectations we were looking back at in March. And top left there, that distressed ratio is really sort of pointing towards that. I want to give one example here. If you take CMA, the global shipping company, this is one of our top default candidates in 2019. We believe they would not be able to refinance with the upcoming maturities coming up in 2021. Global shipping company, hugely cyclical, dependent upon economic activity, also environmental risks. They had to comply with IMO 2020 and the low sulfur fuel for all of their ships. Despite all of that, despite the largest economic shock we've just seen, that default candidate that we were very underweight and benefited in 2019, that company has now had a bailout from the government. It's now got better operating conditions post the crisis, and have now recently just done a refinancing. So even those companies that were in trouble before are actually in a much better place than they post-crisis than they were pre-crisis. So I think that gives a really good sort of flavour of how companies have been able to sort of weather through this period. Now, the weakening corporate credit metrics, that's absolutely the case, that we are going to have more leverage within the system. Companies had to bridge that economic shock by issuing a bit more debt, but we do expect those companies to be in that early part of the cycle to repair their balance sheets if it's available to them. And I think that's the really key point here, because we have to look at different companies and we have to look at different sectors. And you'll see there bottom right, look how low the correlations are between sectors within both the US and also within European high yield. Typically, if you look back many years, those correlation lines would have been firstly much higher, but also much flatter as well. And if you take something like the leisure industry, that's got those sort of cross-border type the airlines, you've got the holiday companies that are going to struggle for a very long time. And yet you also have a company, let's take like Center Parcs within the UK, a real staycation business actually doing very well. It is still a little bit COVID impacted when you have the lockdowns, but as soon as they are able to open up their resorts, as they have done, their ability to get back to earning really good revenues is absolutely there. So there's such a differential. And that's what I really want to talk about next, is the opportunity within high yield. Yes, we believe it's an attractive asset class at the moment, acknowledging the risks, but the opportunity for active managers to both pick the winners and avoid the losers is absolutely there. And I think those correlations really speak to that. Now, when we consider the high yield market, we absolutely consider it's inefficient, but there's three key areas of inefficiency that we believe. The first one is the new issue market, and that's somewhere where we will actively participate in order to invest in, both existing and new companies at attractive levels. We also have some of the smaller issuers within the market, and we will deliberately have our strategy to be smaller than that of some of our competitors to be able to benefit from those smaller issuers that tend to be overlooked. And then the third one is the crossover space, talking about fallen angels and rising stars. Now, if we look top left here, you can see what a significant number of fallen angels we've had through this crisis. Now, it's funny, isn't it? Why would I say fallen angels and rising stars? Now, rising stars are clearly an opportunity for us as investors. Why are fallen angels? Well, if you look top right, you'll see that fallen angels tend to do all of their underperformance, all of their spread widening before they get downgraded to high yield, when they're still investment grade companies. And then when they get downgraded, enter into the high yield indices, that's when they tend to really outperform. The best performing sector within US high yield this year is autos, not because autos is the best performing sector overall, but because Ford, a large fallen angel, underperformed as an investment grade company, and since it jumped into the high yield universe, has only outperformed since then. That's the opportunity of fallen angels. Now, on top of that as well, if we look forward over the next handful of years, a lot of those fallen angels, we believe, are going to probably become rising stars again. And you can see there the number of candidates, bottom right, just from the US high yield market, and there's more within Europe as well. Those rising star opportunities are going to be a really great opportunity for high yield managers over the next sort of 2 to 3 years. Right, so let's go into a tiny bit more detail on some of these opportunities. So Ford, I mentioned there. This is a company we know well. Our analysts cover through both investment grade and high yield. So there's no handover of coverage when we get these jumps from IG to high yield. The analyst is fully aware of what's going on. We were underweight within our investment grade funds as all of this, as Ford was sort of struggling and having to take on more debt to see through this period, and the huge sort of working capital swings they have when they have to close down some of their plants. But in fact, since then, with a great new product lineup, Ford, as soon as it entered that high yield index, you can see that has significantly outperformed the rest of the market. That's the whole market, double Bs, single Bs, triple Cs, even when this is just a double B itself. So it's really outperformed, and this is such a great opportunity. It's such a great example of a fallen angel that we as high yield managers can really exploit. Now, rising stars, obviously we've had how many fallen angels this year? There haven't been many rising stars, but there have been the odd one here or there. And again, this is really the advantage of having a global approach. And by global, we're not just talking about the US and Europe, we're talking about the whole of emerging markets as well. Country Gardens is a Chinese home builder. They had one rating from Fitch, and then in September of this year, they got another rating, triple B rating from Moody's as well. And you can see there the spread tightening of these bonds prior to that upgrade happening. You can't just buy these bonds once they become a rising star. You need to buy them beforehand. And again, this is an opportunity. There aren't many of these rising star opportunities this year, but this is one of note, and we were able to pick that one. Now, we'll touch a bit more on ESG later, but Pure Gym, again, within the leisure sector, but also a really good social story within the ES&G space. So Pure Gym is a low-cost gym operator. To give you an indication, near my offices here, the closest gym to here costs £110. That's what, 120 odd euros a month for their fees. Pure Gym have monthly contracts in other parts of the country as low as £11 a month. This is, even through people getting furloughed, even through people having unemployment, this is still a business model that is doing incredibly well based upon people having access to this low-cost gym environment. It's great for society in that respect, we believe. And again, while still a little bit COVID impacted, you can see the bond price had fallen there, but the recovery is strong. We believe that recovery will continue in a good yield based on the fact that even if we do see further lockdowns, they do have the liquidity in their balance sheet to see through that. And then when gyms are fully reopened and we don't have the rolling lockdowns, this is the type of company that's really going to be able to thrive after that. And the final example I want to give is more within the new issue market. So ThyssenKrupp Elevators. So this was effectively the jewel in the crown within the ThyssenKrupp conglomerate. Poorly managed for a number of years as part of a conglomerate. And again, through collaboration within the team, one analyst was covering it within metals and miners, and then Richard Taylor then covering it within our universe as it then became more of an industrial company. Now it's much better managed, but this is a new issue. This is the exciting bit where we get to buy in at attractive levels. And we can see there, even through this current environment, this is the type of company that can continue to perform, very focused on the servicing of elevators as well, which is still an important part of the business. And you can see there attractive valuations and different parts of the capital structure. Again, that's our expertise, looking at different areas there to be able to pick the bonds that are going to do better within that type of environment. So how does that leave us positioned? Well, as I said at the start, we're positive. Within that -3 to +3 scale of our top-down process, we currently have a +1 score. So that means we believe spreads will tighten, we will get excess returns, but we're not too much more beaten up than that, given some of those risks there. And you can see from that duration times spread ratio, we have a higher duration time spread than our benchmark, around 1.1 times or 110% of that of our benchmark. We also believe, especially within credit, it might be less so within equities, but within credit, actually some of the lower rated companies, single Bs and triple Cs, also tend to be a tiny bit more cyclical. They're the ones that are really exhibiting the value right now, relative to many of the defensives where so many investors tend to sort of herd to. So we do have this view that we'll see a little bit of compression going forwards. That's why we're overweight single Bs and triple Cs. We're underweight double Bs. And then there's always this opportunity within the triple B part of the market, within investment grade, that we can also look, and you tend to find opportunities there that have better risk reward relative to double Bs. From a sectoral basis, overweight areas like real estate, some parts of leisure, but that's nothing sort of international travel. That's all sort of more domestic leisure, names like Pure Gym, like Center Parks I mentioned before. Some of the regional casino companies within the US that have actually bounced back since the crisis very well. And you'll see one of the key areas where underweight is energy. US energy is still in a really tough place, especially many of the independent and the oilfield services companies. They need oil to be significantly higher just to break even on their cash flow, let alone be in a position to really be able to recover. So, if we look at sort of like airlines and energy, they're two of the areas where it's going to be much, much harder for them to be in this early part of the credit cycle and repair their balance sheets. And from a regional perspective, a little bit underweight North America, mostly through that energy exposure. A little bit overweight Europe, predominantly through some single name picks. And then within emerging markets, it's mostly overweight through China and then underweight through those countries that don't have the ability to really stimulate their economy like the developed markets do and like countries like China do. And then ESG as well. We have an integrated process. On this slide, you'll see our bottom-up framework. The really key thing here, I think ESG far too often is just talked about in terms of negative screening. We absolutely believe in trying to avoid losers within ESG, within our integrated approach, but that's looking for companies that have material risks that are also deteriorating. And that's the bottom left-hand quadrant you see there, that blue avoid sell box where we absolutely don't want to invest there. But ESG is not just about avoiding the losers, it's also about picking winners. And because our analysts, our credit research team are also trying to pick the trajectory of those ESG risks going forward, we're trying to pick those companies with improvement to sometimes even material risks that can then drive a lower cost of capital and a price appreciation in the bonds. And obviously Pure Gym being a great example of that. Now, as far as the trends, I think the key steps that the market is taking on at the moment is really around engagement. We're doing a huge amount of work here. And I would say traditionally engagement was very one-on-one, investor with one company. What we're trying to do now is really engage with large sectors in order to try and pit them against companies against each other and try and drive improvements in both disclosure and also ESG type practices. And we're starting to see better results come from that. The European energy sector, we recently engaged with them on better disclosure on scope 1, 2, and 3 emissions. And we're currently in the process of engaging with companies trying to get better disclosure around diversity, both at the board, but also at a company level as well. And even by getting better disclosure, that's the first step in order for companies to start to really look at themselves and start to try and self-improve themselves. Before then, we can then try and work together through that engagement to get them improve on those aspects of their work. It will also be really interesting as well because we've got the EU taxonomy coming up as well. So, the requirements around reporting on ESG is going to be much more significant. And I think this is a trend that's going to absolutely continue going forward and something that we absolutely want to be at the forefront of. With that, I will pass it back for questions.
Okay, Tom, muchas gracias. La verdad es que...
Okay, Tom, thank you so much. We have barely 10 minutes and we have lots of questions. So my task is a difficult one to try and choose from all the questions that we got. We were listening to your presentation. You were talking about different countries, and the question that people have been asking was, what can you say with regards to Chinese fixed rates? Is it not a good incentive, considering what they offer compared to what Western countries offer? Could you explain to us why and what are the risks you see there?
Yeah, it's a good question. The really interesting thing when we look at high yield is that because it is a relatively smaller part of the universe than investment grade or any sort of government market, when we're sort of specifically looking at Chinese high yield, it tends to be focused in one sector, and that's the home building sector. Now, there has been a little bit of volatility here. You're certainly getting paid for that. Some of the yields available from some of those companies is much higher. But again, for us, it's really focusing on, okay, which are the companies where we believe is the right risk reward? And it's also really considering about what type of sort of governmental support is ultimately going to be through here as well. And what's really clear within the market within China, probably relative to any other market in the world, is the ability for China to really support those systemic companies is absolutely there. Now, what's really interesting is that those companies can issue both onshore and offshore. In fact, they do have a great ability to get very good rates when they're issuing onshore as well. But because they are quite indebted companies, they're also looking to invest offshore. But there are quotas there, so they can only do so much. In fact, at the moment, there's actually sort of a case where trying to find that ability to source bonds, it can actually sort of be sometimes a little bit of a challenge. So I think that really does give an indication in a world that's sort of starved of yield, when there are opportunities to earn either sort of high single digits and even some sort of low double digit type of yields compared to the rest of the market, is still attractive to us. We are cognizant there are some risks there, but again, we generally believe there's going to be a significant level of support from the government.
Hablando de apoyo del gobierno.
Okay, so talking about government support, to what extent do you think that the European recovery plan is interesting, and to what extent do you think that that explains your overexposure in Europe?
I think actually when you looked at sort of central bank support, it's probably, Europe's held the baton for for being the sort of most supportive central bank for a long time. In fact, the US probably took over that mantle earlier on this year, and especially with that direct support for the high yield market. To be honest, our overweight to Europe is more based upon the fundamental bottom-up opportunities we see, individual companies. As I said before, we tend to find a lot of opportunities within some of the smaller issuers within the market. They tend to be overlooked by other investors. And within Europe, there's a huge number of those opportunities. And again, what we can find, take a company like Profine, a PVC door and window manufacturer that came with a new issue at 9.25%. It doesn't matter what part of the globe we're looking at. That is an attractive, it's a well-run business, good management team. That's an attractive opportunity for us. It's not because it's based in Europe. It's just because it's an attractive bond and attractive yield with an attractive business profile. So again, in fact, a lot of that European optimism is more based upon the bottom up.
Tom, esta pregunta también.
Okay, Tom, we have another question with lots of votes. Do you think that fixed rate and high yield in particular could be stressed again up to the levels that we saw in March? Could we see that once again with so little liquidity in the market? Managers had problems to sell and buy some emissions. Could that happen again?
I mean, look, we can never say never, but I think what happened in March was sort of significant in that it was the uncertainty that anyone knew, and also clearly we didn't have, the central bank support hadn't really come in yet. This crisis was so different from any other because the new issue market was able to reopen incredibly quickly. The only way I believe we're going back to any types of level like that is if the central bank support were to step back significantly. But yes, we are still worried about, second waves and how that impacts economies. But again, even within, the UK, where cases are rising quite strongly, the ability for people to still go and do the sort of the work that they weren't able to do back in March. One, we're much better, many of us that can work from home, and those people that do still go to work are still able to go to work. I don't believe we'll see the same level of lockdown as we saw in March, where literally everyone then just had to go and sit at home and wasn't working. So I don't believe we'll go back to that. But there is the chance of a little bit of volatility. But again, I think the central bank support is now, they've shown their hand. It's only going to increase going forward. So until that changes, I don't see those levels again.
Pregunta, ¿qué rendimiento espera?
There's another question. What performance do you expect for global high yield in 2021?
Well, I guess it all depends sort of where we start out in terms of yield. And we think there could still be some performance coming through now. But I think, you're going to get some sort of decent levels of yield when you compare it to other asset classes. So you're talking about sort of 5 or 6%. And on top of that, I think you could probably see potentially, another sort of 50 and maybe in a really bullish scenario and a further 100 sort of basis points of tightening. So that's really going to drive, total returns to be sort of much like sort of high single digits and possibly even low double digits. the thing I think is even more exciting on top of that is the ability for active managers to really outperform. What we as active managers don't like is when there's nothing going on, there's no dispersion within the market. That's not the case at the moment. There's so many different moving parts. There's so many opportunities in order to exploit. But hopefully, I believe it's a great opportunity to then even outperform those market returns.
Y la última ya para terminar, claro, entiendo que...
Last question to finish. I am sure that it will depend on the investors, but I'm going to ask you the question. So it will have to do with the investors and their relationship with their managers. But the question is, what percentage should high yield represent in a diversified portfolio, Tom?
Yeah, very good question. And it will absolutely depend. Look, I think high yield... It should be a part of a diversified portfolio. Like high yield is never there for something to be sort of significantly overweight relative to or a large portion, let's say, of the rest of the market. And it depends how that we absolutely view credit in terms of sort of beta. So whether it be investment grade, high yield, whether it be loans, whether it be asset-backed securities, whatever, they all clearly are risk assets and they just have a different beta to them. We currently believe high yield is probably the most attractive of those. But it probably is worth diversifying that clearly against an equity part and maybe an alternative part of the portfolio, but also, again, other parts of fixed income. But at the moment, we'd probably say that high yield should represent a pretty large part of that fixed income element, and especially as well at the moment. Normally, you'd have lots of duration in your portfolio to try and offset against those risky assets. But again, and we saw that in March, the ability for duration to hedge against those risk assets is much more difficult now. So let's say we potentially have an increasing inflation world, in fact, high yield probably will do okay in that type of environment relative to other asset classes.
Muchas gracias, Tom. Ahora que hablabas de la inflación.
Okay, thank you very much, Tom. Now that you talk about inflation, I'm surprised that we haven't gotten any questions with regards to inflation. Thank you so much for your time. It was a pleasure to have you with us.
Bueno, vamos a pasar ya.
Okay, so let's now start with the voting. Let's value this high-yield investment idea that Tom presented to us. So we're going to ask the first question, finect.com/BIOS. So connect to the app and you will get this question. So how do you value Tom's presentation, the investment idea that Tom has presented to us? And the time to vote starts now.
En esta primera, valoramos si os parece interesante.
So first of all, we are going to assess the investment idea. The first one was China, then Europe, and here it's high yield with Tom Ross. Okay, very well. And now let's ask the second question, which is, what did you think about his presentation, about Tom Ross's presentation, and the answers he gave to the questions? And the time to vote starts now. Well, if you really liked it, give it a 5-star rating. And if you didn't like it, give it a 1-star rating. And in between, whatever you want. So now the time is ending for you to vote. Thank you all. We really like for you to ask so many questions, to be so active in your participation. And now we have the next presentation, who is also going to be very interesting. Diversity of opinions, really active managers, over 20 very active managers, a wide range of active investment strategies, ESG, fixed rate, insurance, multi-asset portfolios, alternative investments, currency markets. We are now going all the way to Paris with Nolan Hofmeyer, who is the founder of the Thematics Asset Management, a boutique that is focusing on theme-based investment. They invest in companies that are focusing on this trend of consumers that would rather experience than own, and he loves exercising. So we give you the floor, Nolan.
Hello, everyone. It's great to be here tonight and to have the opportunity to present to you this new fund that we have, the Thematic Subscription Economy Fund. Let's maybe start this presentation with what we have all done in the last 12 hours. So I'm pretty sure many of us actually last night have watched video streaming, have watched Netflix. This morning, because we want to know everything about the US elections, because we want to know everything about the sanitary situation, we have checked our New York Times mobile app to have the latest news. Of course, then we turned on our computer, we turned on Microsoft Office, Microsoft Outlook, Microsoft Word, and so on. And I'm pretty sure all of you actually have prepared all of the presentation that you have attended tonight. And to do that, actually, you have used different tools such as FactSet, Morningstar, and you have compared all of our performances against different indices, mostly MSCI indices. And right now, of course, we are discussing to each other using Zoom. And once we will be done with that presentation, because you're actually missing so much going to the gym, I'm pretty sure you can't wait for Peloton, that company that is actually selling connected bikes where you can have live spinning classes. You are actually waiting for that company to launch in Spain as well. So all of those companies, Netflix, New York Times, Microsoft, FactSet, Morningstar, MSCI, Zoom, your gyms, Peloton, have actually one thing in common, is that they are selling their services and their products through subscription. And this is exactly that shift that we are capturing with the Thematic Subscription Economy Fund. So how are we exactly doing that? So the first thing is we are investing in secular growth. And as we will see, the subscription economy is actually growing fastly. And I'll show that to you in the next few slides. We do that in a focused way as well. So we are two portfolio managers fully dedicated to managing this strategy. And we actually have developed a strong expertise of analyzing such companies. And that's clearly this value added that we're bringing to you, our investors. And we do that in an unconstrained way. That means we can invest anywhere in the world. So we are global investors. We will find investments in the US, in Europe, in emerging markets, and so on. Of course, we have no constraints in terms of market capitalization either. And very importantly, we are unbenchmarked. So we don't use any benchmark to build our own portfolios. And finally, the way we do that is through a responsible investment framework. And the reason is very clear for us. As you have understood, we are long-term investors. So when we invest in the companies, we can invest in that company for the next 10, 15 years. So that's why it is very important for us actually to take all of the ESG risks into account when we invest in a company. So what can we invest in exactly with this subscription economy fund? What are the industries? What are the companies that are using subscriptions? You've probably noticed when you look at your credit card invoice at the end of the month that you are paying more and more for services that are based on subscriptions. So we talked about video streaming. This is one of them. But of course, we are seeing other industries moving there. Video games are one of them. You've probably seen that Apple a few weeks ago actually launched Apple One, a bundle of different subscriptions. One of those subscriptions is actually a subscription to mobile games. We see the game developers doing the same. But what's interesting is that we don't only find subscription in digital industries, but also what we call offline industries. So companies that have nothing digital at all, but that are also using subscriptions to monetize their services. We mentioned the gym operators. We have also retail companies. You may know HelloFresh, a German company, which is actually sending to you every week meals for the whole family that you can cook at home. You get the recipes and you get the ingredients. And of course, you're paying a subscription and you get delivered weekly for those meal kits. But interestingly as well is that we as consumers actually are paying a lot in subscriptions, but we see that transition happening in the enterprise space as well. If you've bought a new laptop in the last 5 years, you've probably noticed that you are actually not paying for a license of Microsoft Office anymore, but Microsoft is actually requiring you to pay a subscription to Office 365. And this is the cloud-based version of Microsoft Office, but this is also the subscription-based version of Microsoft Office. And we see actually all of those cloud-based software now using the subscription as a way to monetize those services. And there is another industry that we like quite a lot. We call them information service providers. So these are the companies that I mentioned in the beginning. That would be FactSet, that would be Morningstar, that would be MSCI. So these are companies that are very critical for some industries because we need to access those data to do our daily job. Without them, actually, we cannot even work. So these are very critical information providers, and we find the same kind of providers in other industries, in the medical industries, in the legal industries, and so on. So this is a very big part of the investment universe of the subscription economy fund as well. So right now, consumers are actually spending already $237 a month in the US on subscriptions. It's 130 euros in Europe, as you can see. But what is really interesting on that slide actually is that it only represents 5 to 6% of consumer spending. So we still see a lot of opportunities to grow those services that we pay via subscriptions in the future. Some of the largest subscription services that you can see here, not surprisingly, actually one of the largest subscription services in the world is actually one of the Chinese telecom operator, China Mobile, with close to 1 billion users. And you can see here Microsoft Office. You can see Netflix, Amazon Prime. They all have between 150 and 200 million subscribers. You can see a company such as Costco, which is a club warehouse, 50 million subscribers. And very interestingly as well, you can see Adobe, which is a B2B service here. So they are selling products directly to businesses. You see that you have way less subscribers, but actually the cost of such a subscription is much higher. It's around the $30 a month, so that employees have access to Adobe, while all of those other subscription services, usually for consumers, we pay them $8 to $10 a month. We see 3 basic reasons why the subscription economy is growing and will continue to grow in the future, why consumers and enterprises are subscribing to more and more services. The first reason is clearly tied to technology. Digitalization has actually made subscribing to services very easy. You just go to the Spotify website, you fill in the subscription form, you give your credit card details, and in less than a minute, actually, you're already a subscriber. So technology is clearly one of the secular growth driver of the subscription economy. The second one is more tied to demographics and to the consumer preferences. And we know that actually subscriptions are bringing a lot of convenience to consumers when they consume the service. So think about Netflix again. You can watch any movie as many times as you want, wherever you are, whenever you want, and so on. So that's clearly that convenience of consuming that appeals to consumers. And of course, we see actually younger generation where the ownership in itself doesn't have as much value as it used to have for older generation. They actually don't care owning the DVD. What they want is actually just enjoying the movie. And finally, the last driver of growth is sustainability, as actually consuming through subscription is much more durable, because a planned obsolescence doesn't make any sense in a subscription model. The vendor is actually paid every month, every year. And if the product or the services isn't working anymore, it would be the responsibility of the vendor to change or repair the products. So we're now in a situation where the vendor is actually every incentive to have a very durable and solid product. And one of the characteristics of the subscription economy and why vendors are also very happy to sell subscriptions, it's because it's a very attractive business model for them. And that comes to the visibility that the subscription is bringing to those companies. Think about it, a company that is doing $100 million of revenue today, and they know that on average, 75% of their subscribers will renew the subscription each year. You already know that next year you have $75 million in the bank account without even selling a new subscription. So that's this visibility that is very valuable for all of those companies. And we have seen that actually in March, April, where actually nobody knew where the world was going on. But all of those companies that were selling subscriptions, they had that visibility over the rest of the year. And they even had the visibility into 2021, thanks to those renewals of subscriptions. And here you can see if you try to value the revenue stream of a subscription, of course, selling $100 in the product economy today, so selling $100 of bottles of wine, it has a present value of $100. But selling $100 of subscription today with 75% of subscribers renewing each year has actually a value of $314. And now, if a company is actually able to improve that renewal rate from 75% to 90%, the value of that subscription is actually $550. So that's exactly this value that, and this is exactly the value of this visibility that the companies are getting in the subscription economy. And this is why vendors, but also investors, are actually very happy to buy subscription-based companies. Here on the next slide, you can see some of the renewal rates that you can observe in the different industries. And as we said, it has a very large impact on the value of a subscription. So that's why here we are showing you some of those renewal rates that you can see. B2C companies usually are around 75% renewal rate. B2B companies around 90%. Companies such as MSCI, that you know very well, are actually closer to 95%. Quickly, a company example here. This is a company that we own in the top 10 of the fund. This is called CoStar. CoStar is one of those companies that is offering information services. So this company is actually selling commercial real estate data to real estate agents in the United States, but not only to real estate agents, but also to bank, to insurance, and so on. And this is by far the largest commercial real estate database that you can find in the US, with actually none of those databases being public right now. So this is why CoStar has actually so much value. And obviously, for customers to access those data, they have to pay a subscription. So in terms of performance, what does it all mean to invest into subscription-based companies? So the fund is actually pretty young, was launched in December 2019. Actually, despite the fact that it is a very short history, we had the chance to go through different market phases. January, February, where markets were very quiet, same kind of bull market that we had in 2019, 2018. And the fund actually outperformed global markets during that period. And then, as you all know, February, March were months where the market drawdown was very strong. But the fund in that period was also able to outperform the global market. And that comes to the fact that these are very resilient business model, as we were saying. So this is back to that visibility argument that I was mentioning before, where those companies, they know what is going to happen for the rest of the year because they have that visibility, and people were actually not afraid to invest in those companies because investors as well had the visibility over the rest of the year when investing in those companies. So that's why they outperformed on the way down. And then obviously we had that strong rebound from March until now. And there again, the fund has been able to outperform. So again, we think this is a fund that is benefiting from the strong growth of the subscription economy. I think you and me, we see it. We see that if we look at our credit card invoice every month, we are seeing that we are paying for more and more services in terms of subscription. So we know that the subscription economy is growing fast, and this is clearly a fund that is giving you access to the growth of the subscription economy. And with that, I'm happy to take any question that you may have.
Muchas gracias.
Nolan, thank you so much. How interesting your talk has been. And you may imagine we have an awful lot of questions piled up for you because we have a very interactive audience. Finect.com/BIOS. You can ask all the questions, and I'm going to try and summarize them. Many of them summarize as follows. Don't you think that subscription can be a sword with two edges because companies are forced to add value at all times because there is no permanence? If there is no improvement, they can discontinue the service or their subscription. What do you think?
Yes, of course. And I think this is clearly our job as active managers to still do our analysis of the fundamentals of the company. And all of those companies, they need to continue to improve the service so that actually customers continue to subscribe to the service. And I think one of the companies that has done it very, very well over time is Netflix. So Netflix has invested very early into original content because they knew it would be crucial for them to keep their subscribers. And that's a very good example of a company that is taking it very seriously and that want its subscribers to continue to subscribe and to renew year after year. So as portfolio managers, this is clearly our job to find those companies that are able to improve the service and where we know that subscribers will continue to renew the subscription year after year. And that's why we are monitoring renewal rates very closely, and we are also looking at products and the services that they offer.
Esta pregunta dice, hay una pregunta.
I'm going to group two questions in one. Don't you think that these subscription-based models can be collapsed one day, exhausted one day? Do you think another company will be born with several subscriptions encompassing several subscriptions that can really reduce the revenues from these companies?
Yeah, so I think collapsing, not necessarily. I think the idea of selling subscriptions is clearly that the subscribers have actually access to offers that are delivered very regularly. You have access to content that is pushed to you on a very regular time frame as well. In the B2B space, you actually have access to software updates and so on. So I think the best way to monetize those services is actually through subscriptions. And that's why we are seeing that transition. And that's why we think that the subscription economy will continue to thrive in the future, because you actually have to focus on the customer when you are selling subscription and not focusing on the product itself. So it is a very customer-driven approach to selling. No, of course, I think the second question was more about bundling different subscriptions together.
Yep.
And I think we are seeing many companies doing it. Apple has done it a few weeks ago with Apple One, which is actually a bundle of different subscriptions. And the way those companies are doing it actually is very smart, because they look at on average the number of subscription that the consumer has. And they know that on average you're maybe paying $9.99 a month. And if you pay to subscription, it will actually cost you $20 and you don't do it. But if you now have a bundle for $15, you actually have a 50% upside to ARPU, even though people would not have taken the two subscriptions. So, of course, bundles are also a way to actually increase ARPU in the future for those companies.
Nolan, preguntan si crees que compañías como...
Nolan, do you think companies like Peloton can suffer once the entire lockdown's gone?
Yeah, definitely. I think some companies have actually benefited a lot from lockdowns. Peloton is one of them. I think I mentioned HelloFresh at the beginning. HelloFresh is one of them as well. We are actually seeing the valuation of those companies that are getting very high as well. So we have been taking some profits on those companies on the way up. And of course, at some point, when we have a reopening of the economy, when we have a vaccine, those stocks will probably suffer. And that's why I think it is important to note that we have a very diverse portfolio with many different industries and many different companies that are in the portfolios, and some actually will benefit from the reopening of the economy. So Peloton benefited from lockdowns, but the gym operators, companies like Planet Fitness, Basic Fit in Europe, are actually gym operators that suffered because of the lockdown, and they will actually benefit from the end of the lockdown and from the reopening of the economy. So we are very diligent about having a portfolio that is well diversified and where we can benefit actually from both a lockdown that may last longer than expected, but also from a reopening of the economies.
Un par de preguntas sobre valoraciones.
A couple of questions about valuations. Don't you think that many of these companies are very expensive, overvaluated? Many of them are technological, and many users argue that the technology is already having very expensive ratios. What is the difference against a more technological portfolio? Thank you.
Yes, I think they are actually, in terms of valuation, of course, it has been increasing over the course of the year. And I think something that we look at very closely is actually the premium that we pay versus the global market. And that kind of premium hasn't really moved since the beginning of the year. So we're still paying the same kind of premium versus the market for those companies from prior to COVID or from before at the beginning of the year. Now, in terms of apps, in terms of why we are happy to pay that premium, I think it comes back to the argument of visibility. Why would I pay the same price for a company that has no visibility, that doesn't know what's going to happen in next month, versus a company that has 75% visibility into 2021 revenue? Of course, I'm going to pay more for these companies. And in addition, many of those companies are actually growing faster than the rest of the market. So that's why we are happy to pay a premium for them. But of course, that premium needs to be monitored, and we are not paying too much for those companies, and we monitor really that premium over time, and we don't want that premium to go higher than what it used to be in general.
Nos quedan dos preguntas. Bueno.
We've got two questions about specific industries. Do you think that financials will have to reconvert itself? Banks offering subscription-based, for instance, services?
I think in a way it's already happening. Just ask yourself how many of you are actually using Revolut today. Revolut is clearly disrupting the way consumer banks are working, and today I'm actually a subscriber of Revolut, and the idea is, again, you pay a subscription and you have everything that is included: your credit card, the transaction fees, and so on. And it's much more interesting for a consumer because you know exactly what you're going to pay, and then you can use it as much as you want. So I think banks are clearly going through that transition as well, and we see it already happening.
Y el otro sector es educación.
The educational sector. Do you think online education is going to open up new opportunities? Thank you.
Yes, we have one company actually that is active there. It is called Chegg in the US, and this is actually a subscription-based tutoring model. So students they want to get helped on some issues that they have during studies, and you actually pay a subscription and you can use the tools that Chegg is offering to you. So this is one education-based company that is offering subscriptions today, and yeah, this is probable that we'll find more of these in the future as well. Sure.
Nolan.
Nolan, thank you so much for your time this afternoon. We've got many more questions, but no more time left. Thank you very much for being with us.
Thank you to all of you. Thank you very much. Bye-bye.
Muy bien, pues vamos a pasar ya.
Let's now move on to so let's move on to another theme now, Finect.com. The time for the rating starts now.
Ya sabéis, Finect.com/BIOS, cuando accedéis ya directamente os sale la pregunta para votar, con lo cual no tenéis que hacer nada, simplemente darle a votar, ¿de acuerdo?
Just vote. The second one, which is also very interesting in order to understand what are the most popular PMs. Do you think Nolan's presentation was okay about investment? Thank you.
Ya sabéis, 5.
1 is the lowest, 5 is the highest. Thank you very much for your very active participation. Thank you very much indeed. And in Twitter, we've got some questions. How can we connect to the presentations? You've got them on the BIOS group on Finect. As they finish their talks, they will be soon uploaded. You have some of them fully available to you. So that's it. You can find it. This is the last day. We will have another session tomorrow, but let's dive into the last keynote speaker of this first BIOS session for 2020.
Cerramos esta primera.
And we will just finish this first session again with Ned Naylor Leyland from London. He is the head of old and silver at Jupiter, where he applies his specialty in the precious metals. He believes that gold is going to become part of the group Everton that has joined him more to Spain with the acquisition of the Real Madrid players. Ned, here's the floor. Thank you. Hello, Ned. Over to you.
Thank you very much. That's immediately going to make me very unpopular with many Spanish football fans, whether they're Real Madrid or Barcelona. But I am indeed an Everton fan for my sins. First of all, thank you so much to the organisers. I'm sorry we're not down in Spain meeting with you all. Thank you for the opportunity to talk to you about a subject which is close to my heart and is, I would say, quite poorly understood in investment circles, which is gold and silver. What I'm going to do is split the time. Hopefully we can have a full 10 minutes of questions. I'll split the time between trying to confuse you or change your mind about what gold and silver are initially, which I believe is very important. And then I'll introduce maybe the right way to think about how you can allocate towards the asset class, what the best way of doing that is. So with that, I will go to my first slide. And what this seeks to convey is that gold and silver are monetary metals. Gold and silver are physical metals, physical commodities, but they trade in the monetary system, always have done. And that is evidenced by the fact that both metals are found traded in foreign exchange, in physical form, and in futures and options. Now, that's not true of other commodities. So you won't find nickel or oil trading in the foreign exchange markets. And the reason for this, of course, is due to history, which is that the upside down world of Stranger Things started in 1971 when the US defaulted on the Bretton Woods monetary agreement. And that world still continues now, although I would argue it's in some trouble. But it's important to understand that central banks have these huge gold reserves because they understand what the risk-free instrument of the system always was and always will be. Gold has no credit rating and it doesn't need one, and that's for a very good reason, which is it's actually the constant. There are some very good books. If you're into dry academic financial literature, The Golden Constant is one to read, but there's plenty of evidence that gold actually measures your loss of purchasing power, or rather holds its head against goods and services over long time frames. Now, this is very important because if you really properly understand that point, physical gold is actually not an investment. In fact, it's the only thing which isn't an investment. Holding physical gold is to hold the risk free. So it's disinvesting. You're saying, I don't want to participate in the current financial market architecture due to whatever reason. And that's why central bankers have lots and lots of gold, and they hold each other's debt because they have to. And they have absolute certainty in one, and let's say skepticism or rather a good level of understanding of the other. Now, of course, that's not quite true of silver, although gold and silver really is one thing. Silver got demonetized 50 years or so before gold did, thanks to its extreme utility for industry. So there was a users association formed straight after Bretton Woods and World War II, which got hold of silver at very cheap and, well, really below market prices for a very long time, had it taken away from coinage. But of course, as in Castellano, you know, whether it's plata or argent or shekel or the pound sterling, you know, money really historically was silver more than it was gold. And both of them still have that monetary sensitivity. So it's about the arrival of capital flows in foreign exchange markets principally, but also futures and options that drives the price of gold and the price of silver as you see it on the screen. But there is something more here, which is, of course, that, and this is the point I was saying, I'm going to try and confuse you, but I'm not trying to confuse you. I'm trying to reveal something, show something that was always true, which, of course, actually is what the word apocalypse means as well. It means the unveiling of something that was always the case, which is that if you, I'm going to go to this slide here, if you actually think about gold the correct way, the gold price doesn't even go up. What's happening is gold measures the loss of purchasing power of individual government-issued credit. And that credit really goes down the stairs against gold, rather like a slinky, one of those children's toys that rolls downstairs. We're starting a stair. People like me think it's the final stair due to the fact that this arrangement that we are sort of coming to the end of at the moment was never an arrangement anyway. It was a default by the US of the agreement of Bretton Woods. And it feels very much like we're in the end game. You're hearing lots of words about reset, but it's vital to understand that when you own physical gold, it has no return it is measuring. And that also is important when you think about attribution. So if you think about a portfolio, if I buy physical gold in a portfolio, let's say I put 4% in a gold ETF, that's going to have a currency-like return for you in a portfolio. It's not going to turn into Superman. You may think it will, and of course, gold, intuitively, we understand the important points, but we don't necessarily realize how to apply that at portfolio level. And physical on its own will not do a Superman style change of clothes. I think it will do very well because it's going to measure the loss of purchasing power in your local currency, but it's not an investment. Now, so far I've said a lot of things you might think are opinion. Have I got anything that really evidences what I've said to you? So I think the key thing to realize, and the thing that took me longest to understand about this subject, is that price discovery for gold happens purely through the mechanism of real interest rates. So if you think about the global cash and currency market and bond market as well, it's an absolute monster. And every day, your local currency, whether it's a euro or sterling for me, is being judged relative to domestic real interest rates and gold. So what you see here is sterling gold at the bottom against sterling long dated real interest rates. So effectively sterling held for 7 to 10 years will be the opposite of the sterling gold price, and likewise the dollar. And this is a very important observation because it isn't about the dollar on its own. It's certainly not about inflation on its own either, or interest rates on their own. But the sterling gold price will depend on the direction of real interest rates in the UK and the dollar gold price, and likewise the euro gold price. And if you look back over reasonable timeframes, you'll see that this is where the action happens. And it's because the gold market is $200 to $400 billion equivalent a day. It's a massive market. So, of course, that's where the action happens. It's never going to be in physical. And that also is true of silver. The price discovery comes through real interest rates. Silver just has a beta because it's about 1/10 of the size of the gold market overall, which means it's much more sensitive to capital flows both towards and away from the instrument. It's also worth pausing and thinking a little bit about the historical relationship between gold and silver. I would say that it doesn't mean revert. So the ratio of 1 ounce of gold to 1 ounce of silver. So if today I had 2 plates, one with 1 ounce of gold on and another with 70 ounces of silver on, which would you prefer? Well, the answer is they're the same price. So there should really be no preference. Albeit, I'm going to tell you, you do want the silver. It's a value proposition. It's also play on direction and momentum. However, in Asia, people will go with the gold coin. That's a psychological thing. They like the high-priced item. It's a gift-in good. And the Asians think about gold in a different way, although likely silver gets very expensive and that will change too. But I think that the thing to understand here is that the gold-silver ratio reflects both the trend for real interest rates. So if real interest rates are trending higher, you'll see the gold-silver ratio trending higher. In other words, silver underperforming gold. And as real interest rates fall and both metals rise, this ratio falls with it. And we think there's a huge amount of room to go lower here, particularly as while silver's price discovery happens through real interest rates, there seems to be a clear problem in physical. I think that the key consultancy group, they're called CPM Group, in May suggested they thought there'd be 80 million ounces of investment demand for silver in 2020, which is double last year, due to what was happening and stimulus packages, etc. Well, since that moment, the biggest silver ETF has added 300 million ounces on its own. Now, I believe that there's an issue here. I think that there's going to be a squeeze in silver at some point. It's difficult to say when, but everything tells me that this particular graphic, so the relationship between gold and silver, should capital flow towards the metals and towards gold, silver should outperform based on the architecture. It's not really an opinion, it's just an observation about how this market works. And then you might say to me, well, what about these mining equities? Aren't they a bit of a nightmare? Well, the answer is, for a long time they have been. They've been very difficult to invest in. And the reason they've been difficult is expressed by the gold oil ratio, which is the dark green line here in the presentation. And what the gold oil ratio is, or rather, sorry, the light green line here, is the price of a barrel of oil relative to an ounce of gold. And through recorded history and certainly modern market memory, it's been in a very tight band, been trending around the same level for certainly 20, 30 years, going back to the late 80s. It was probably the last time that it was volatile. And what we saw, of course, this year is that the relationship totally changed and oil got very cheap for gold and silver mining companies. And this is really important because gold and silver mining stocks, if you buy them, are like call options. We like to own 30 to 40 at once to spread the risk. But understanding that cost inflation relative to the spot price of gold and silver that you're selling, as well as FX, in fact, are very important to the outcome. And certainly between 2000 and 2012, gold and silver mining companies having a terrible time due to rising oil prices, falling US dollar, which is bad because mining companies most of the time pay their workers in the local currency. So that was bad as well. And it was a super cycle, which meant everything to do with mining was just getting more and more expensive. But what we've seen this year is this very strange situation when, just as the monetary system seems to be going to terminal decline, real interest rates plunge. We're starting to find gold and silver exploration companies are finding new mining projects. Not many, but they're just starting to emerge. And the relationship between gold and oil decoupled. And it feels like it's just all very end cycle and very much plays into the point, which is gold and silver mining stocks as a form of call option on the problem of real interest rates and monetary distress. In truth, they only ever have their moment in a very specific market environment, and that does happen to be now, because they can deliver ongoing earnings and margin expansion, and the big ones will continue to pay rising dividends too. It's just a very specific environment. I think just as financials are hurting from the yield curve where it is and the monetary system in the state it is, gold and silver mining companies are the inverse of that. Think back to the real interest rate slide. It works a similar way. And I would say that Warren Buffett allocating, albeit a tiny amount, away from financials and towards Barrick is very much indicative of both the structural case and also what we should expect in terms of global asset allocators who finally wake up to the opportunity here. There aren't that many sectors that look better now than they did a year ago. And there certainly aren't that many that look miles better than they did a year ago. And that is absolutely the truth for gold and silver miners. Silver miners are a later stage opportunity set, more margin compression, more upside. And I like them because I think it's a way of adding optionality. I don't have to pay additional premia. There's no additional time decay in holding silver miners over gold miners, but there is implicitly much more upside, and their current margins are lower. So therefore, you're involved in higher margin gearing as the spot gold and silver price hopefully continue higher in this current monetary system. And this really, I suppose, is re-emphasizing this key observation, which is you can buy gold, and I suggest people buy gold. Physical gold, particularly. I don't know about what happens in Iberia with tax on coins, but most of the places in the world, you buy your local coin. It's a tax-free monetary instrument, and I think physical gold held outside the system, the risk-free instrument, has huge merits, and I will always, within a portfolio, have a large proportion of it in physical metal. But it is a bit of a passive position. So, I think it's important to understand that both gold miners and silver miners, but also silver over gold, they represent a form of additional beta. At the moment, it's not that high, 1.5 to 2x the underlying gold price. But that can blow out, and that blows out, or rather theoretically would blow out, with participation. And participation is still extremely low. And in a world which is driven by momentum, and a sense that you don't want to get left behind. Benchmark tracking. A lot of active managers are either at zero in gold miners relative to their index or underweight. And I believe you'll see a lot of chasing in due course. It feels a bit like we could have gold fever due to what's happening in the monetary system. At the same time as you get a bit of a gold rush with gold and silver mining companies who are now really out spending money, drilling, trying to find new projects. It's taken 30, 40 years for this to happen. It's caused a structural issue in our sector. And again, when we think about the opportunity set in the asset class, we're always thinking about that and say, look, wouldn't we rather be invested in call options that people want to pay a premium for versus in ones that are consuming their reserves and are in need of going out and making acquisitions. So it's another trend and something that we think about actively. Valuations wise, gold and silver mining stocks are trading between bull and bear market on a backward looking basis. These are the kinds of things that matter to us as investors, because always we've got to look at, we have a very narrow universe, actually. Only about 100 stocks qualify on geography and management and all those boring usual filters. But within those, we have to justify, particularly on an asset value basis, why we're holding something versus something else. But I would implore investors to think about gold and silver miners overall as a form of call option on the underlying observation about what's happening in money. Now, each one of these gold miners or silver miners has a lot of operational risk, and you need to try to mitigate that as far as you can. They'll still go wrong sometimes. So having a distributed exposure, we believe, is crucial. But we think also it is still very early. And while these metrics don't look punchy, I wouldn't even be worried if they were, because in terms of participation, we're still very early. Even if gold and silver miners trade at 2 to 3 times net asset value, if the gold and silver price is continuing up due to real interest rates trending down, then I would anticipate, so long as costs don't start to spike, these things can continue to swell and grow and sort of slightly defy objective analysis in terms of normal equity market analysis. It's a very specific subset, the gold and silver mining space. I'm going to dial it in a minute because I hopefully leave some time for questions, but I would also just draw reference to the fact that there is clearly something happening, and it's been happening for a long time. It's not just to do with COVID. 2 years ago, Juncker at the European Parliament, it was the opening of the European Parliament speech, said it's absurd that Europe pays for 80% of its energy import bill, $300 billion equivalent in US dollars, when roughly 2% of our energy comes from the US. That was a direct observation, or even more than an observation, about the petrodollar system, and that was 2 years ago. You think of what's happened, what's happening, the direction of travel we're on is towards a new Bretton Woods, which actually, now that I say that, of course, was announced by the IMF as an idea over the weekend, a new Bretton Woods. Well, my belief is it's very much time for that. They've been telling you it's coming. Gold will always be the center of it, because it's gold that's the risk-free instrument of the whole system. You haven't needed to know this for a long time. But right now, watch what the central bankers do. They'd like to buy more if they could, and they're asking for their gold back from each other. They don't trust each other at this point in the cycle. They want it back, want it back. That tells you something very important about where we are in the long cycle, in my opinion. And with that, I shall hand back. Hopefully that's about right on time.
Muchas gracias, Ned. Vamos con las...
Thank you so much, Ned. Yes, we have a few questions. You know that people can vote on the questions, and the one that has more votes is the one that I'm going to ask you. It's a question by Luis, and he talks about the Article 1.10 of the U.S. Constitution that establishes the relationship between gold and dollar. And he says the first question is whether you think that somehow dollars or any other currency could be linked or is linked to gold and silver, and why?
They always were, and technically even still are. So remember that in 1971, the US temporarily suspended the convertibility of the US dollar. That was a temporary suspension. That's still in place now. The reality, now I am now entering opinion, but I think it's quite obvious that at the end of the cycle, gold extinguishes the debts and then you start again. So it's not a radical idea. In fact, it's just a revelation of an obvious truth, which is that's why central banks hold both things in their reserve base. Because, of course, gold is like sometimes I like to say this, hopefully some of you have seen the original Ghostbusters movie. At the end of it, there's a box on the road and they're all standing there with their guns. And the box receives all the ghosts into it. And then in the end, and then the lid goes. That's how you need to think about gold at this point in the cycle. It's always like this. It's just that people don't think in long cycles. People like to think in very short cycles. And also, that's not all the story as well. It's also true that the regulators and the central bankers and the financial services industry don't like this subject being spoken about much. So, it's not necessarily that common to talk about it.
Relación que se
We also see in the U.S. Constitution, well, this investor tells us that he would like you to give us an objective price, some number for gold linked to the euro or the dollar, in relation to both euro or dollar.
Well, look, unfortunately, I'm sure the person who asks this knows I'm not going to give you a number. But I will remind you why I'm not going to give you a number, which is that all that happens is that euros go to zero eventually, as do dollars. So it doesn't work like that. However, if you want to look at let's say the US dollar gold price, where it is now and where it might be going, now, and I do also keep that chart on my screen, looking at it going up, even though I know that doesn't happen. What I would say is go back to, I don't know if my slide pack is still visible to you, but I'm going to show you something which I went past earlier, which is that in 1978/79, the US dollar gold price reached a level that it had been at previously in the 1970s. So effectively, it went up a lot in the early 1970s after Nixon, the gold price. It came back down 50%, and then it rallied again. And when that number left behind properly the high from the earlier period in the 1970s, it just went straight up, as I'm sure that this particular person asking the question knows. And I think we're very close to a similar outcome because effectively the high that we had in 2011, 2012, we broke it recently, but we've then come back underneath it. We're testing it. And I think it looks very much like that cycle in the late 1970s. And I think that when the market understands that the previous high of, let's say, $2,000 an ounce is dust, is the floor, then I think it's just going to come pouring in the asset allocation towards gold. And then I think the price will start to move in a geometric way.
Ned, tenemos varias preguntas relacionando.
Ned, we have a couple questions that try to pair Bitcoin and gold. Do you think that the Bitcoin will, in the end, be that refuge value, will substitute gold? And, well, actually, both questions are the same thing. If Bitcoin will end up substituting, replacing gold?
Bitcoin definitely won't replace gold. Bitcoin is interesting. It's probably going to be reverting to its natural utility, in my view, which is the evasion of capital controls. So getting around capital controls is what Bitcoin has proved to be very useful for. Cyprus, Greece, there have been several examples of this where it actually becomes useful. I think it has, for me, Bitcoin is training wheels for a system that's coming. So I think it's all very interesting. It's not on rails. So gold and silver, fortunately, and gold and silver mining stocks are on rails. You can allocate them easily. They are accepted instruments in financial circles. Bitcoin is not for good or bad. It causes all sorts of issues if you try and deploy at a portfolio level. But I do think that, yes, I think that the central banks are likely to want to try and use some kind of fully lit distributed ledger with no friction. In other words, we might have some currency system which is centralized and fully lit. So everything you do would be monitored, be a full cashless society. And I think that Bitcoin is part of the story to getting there rather than the solution. That's my opinion.
Preguntan aquí, bueno.
And there's another question. Maybe you said it during the presentation, but maybe you said it. Is it better to invest in the physical raw material or in companies? And then with regards to companies, do you think that the business models that companies with royalties are better than the explorers and developers and so on? And do you think that this is justified?
So the way I think about mining companies is you want a nice distribution of different kinds. There are times in the cycle when some do very well. And actually, yes, explorers and developers, I think, are very interesting now. They've been terrible for a long time, but the industry is massively short of reserves and they have to be found. You don't just magic them. They don't come from nowhere. And one of the reasons this has happened is because the gold price, through the mechanism of real interest rates, has been too low for the major gold mining companies to have sufficient free cash flow to reinvest in new projects. So I very much believe that tier one jurisdictions, this is pretty much, in my mind, Australia, Canada, and Mexico. You can invest in very interesting tier one and growing development and exploration potential tier one exploration assets in really good jurisdictions for cheap multiples still. And I think there's a lot of opportunity there. And overall, to answer the original question, I just go back to what I said to you before. Physical gold isn't even an investment. It's removing yourself from investment. Whereas gold miners are a way of being active about the problem of money, real interest rates, and the issues of holding cash, near cash, and fixed interest instruments, which the market understands are probably degrading.
Nos queda muy poco tiempo, así que vamos.
We don't have much time, so since you talked about taxes and so on, someone asked, do you think that a government that intervenes too much could have some sort of tax for gold ownership, for quite specifically?
Well, no, look, I mean, I'm aware of history and all the rest of it, but my personal view is that the state, the system, will be very happy to reintroduce gold. This is the thing that people will be surprised by, because ultimately, so long as the central banks have total clarity and visibility over everything, they have control and they have gold. So, look, I think that the thing to recognize here is this system is going through a very important change at the moment. The central banks are the ones who are in control, and they issue paper and hoard gold. So at portfolio level, you have to think to yourself, do I want pure paper? Do I want to mimic a central banker? And do I want to be active? None of these things are easy. And within a portfolio, my conviction is you need physical, you need silver, you need exploration companies, you need a blend of things. But one way or the other, I can tell you it's still very early. And only, that allocation, that tiny allocation, 0.1 by Buffett, is a real sign of what could be coming.
Y ya para terminar.
And just to finish, Ned, they ask me, besides gold and silver, what other raw material do you see as having more potential?
Well, that's an interesting question. Look, because other raw materials are not monetary instruments, they trade more on supply and demand. Now, I mean, I think there's an argument about the inflation cycle, where we may be going. Do you want paper assets or hard assets? There's always an argument for raw materials and commodities. Personally, I think industrial commodities, I look at what's going on, not convinced that the structural case is there for them. Copper might be a bit different. Copper, by the way, is also a monetary metal historically. The word cash comes from a copper chain of coins that people used to wear. So copper also has a monetary component, but not in terms of its price. I would say things like farmland and forestry are probably the better end of that world looking forwards, but I'm no expert on that. So please don't quote me on it.
Muchísimas gracias por...
Thank you. Thank you so much for your time, Ned. It was a pleasure to have you here today, especially at this time of day when in London you're usually having dinner. So thank you so much for your time.
Not a problem. It's been a real pleasure.
Thank you. Muy bien, pues...
Okay then, so we just finished this last presentation, but please do not leave because we need to vote on it. We really are very interested in knowing what you think about this investment idea that Ned proposed to us, and we're going to vote on it. You know that it is finect.com/BIOS, so please vote, and the time starts now. Thank you so much to those of you who are participating and voting. We love your likes. Those of you who are watching the videos, please hit on the like button because that helps. So likes. And okay, thank you. Thank you so much for your votes. And now let's vote for the second question. What did you think about Ned's presentation in itself? So now, and the answers that Ned gave to your questions. And now you can start voting. No, Ned Naylor Leland from Jupiter Management. So we're going to ask you to make a little effort because it means a lot for us. So please vote. Tell us what you thought about this first BIOS day so that we learn not just for tomorrow, but for the next events that we organize. So that's the question that you're going to see. You're going to have different options going from 1 to 5 stars, whether you liked it more or less. So the time to vote starts now. Did you like it a lot? Did you like it less? So what did you like the presentations? Were the presentations too long? Well, those are some ideas. So if you really did not like it, then just 1 star. Thank you all so much for participating. And I just wanted to remind you that we will be here tomorrow at 4:30 again. So please don't miss out on any of the things that are going to happen because we have an amazing agenda. You have all the information on the group, and some users said, how can I see the profitability? Where is this fund being sold? You have all of it in our group, in BIOS Finect's group, and in some of the funds you can actually start hiring them within our funds platform that we launched a couple months ago. You have it all there. The presentations are there as well. All the links for the certifications, if you are professionals, are there as well. So you have everything in the group, and if you're not a member of the group, then become a member because you have lots of things waiting for you there. So that was all. Thank you very much. We hope you have a lovely afternoon. Thank you for following up on everything that has been done by this amazing group of professionals that have done everything. And you have seen that we have had people from London, Paris, Hong Kong. These are complex events, and we had lots of professionals helping us organize this. So thank you. I would like to thank the team, and we will see you all tomorrow on Tuesday 20th at 4:30. Thank you very much.